Taxation. Today, there are two more very interesting sessions. Two eminent speakers are going to impart their knowledge. The first session is going to be taken by CAS Krishnan, a chartered accountant par excellence. So he is going to impart his knowledge on behalf of Bangalore branch and on behalf of all the participants here. Hearty welcome to CAS Krishnan. Hearty welcome, sir. Friends, the another session is taken by CA PVSS Prasad from Hyderabad. He is here to join us. So let me take a minute or two to inform you about upcoming program of your branch. Day after tomorrow, Sunday, is International MSME Day. Branch is conducting a program along with the Pina Industries Association. It is in the evening 3 to 5:15 p.m. 2 hour session. 2 hour CPE also available for members who are joining the whole session. The inauguration of that program is going to be done by our Minister for Large and Medium Industries, Government of Karnataka, Sri Jagadish Shettar, is going to inaugurate that International MSME Day. I request all the members to register that program. An eminent chartered accountant is going to talk on the subject, various incentives available to MSME, and also how a chartered accountant can add value to MSME. Two interesting topics. An eminent chartered accountant is going to explain to all the members or participants. I request all the members to register that program. July 1st is CA Day. Your branch is conducting very interesting program in the morning. 9:30 is a flag hosting. CA R. Balakrishnan, our past president, is going to be the chief guest for that inaugural session. In the evening 4 to 7, we have two very interesting sessions. The first one is 2 hours panel discussion. The panelists are CA Mohan Das Pai, CA Nilesh Vikamse, our past president, CA Padmini Srinivasan, CA Dayanima Sharma. The panel discussion moderated by CA Gururaj Acharya. I request all the members to register that program. And the last session is Dr. Gururaj Karajigi is going to take up. He is going to tell how we can grow our kids. Again, a very interesting session. I request all the members to register both the programs, International MSME Day on 27th June and 1st July program. I request all the members to register that program. With that note, once again, hearty welcome to each one of you. Over to our program coordinator, CA Kotai Srinivas.
Good evening, members. Once again, let me also welcome Krishnan for this session, Pranendra, the treasurer, and also the chairman, B.T. Shetty. Today, we are having two topics to be discussed. One is foreign tax credit, the other one being equalization levy. Of course, this is an international tax workshop. When we talk about any subject, we correlate with non-residents. But when it comes to foreign tax credit, we may have to understand, like most of our practices, say small and medium practitioners, it is not that we'll be handling or addressing the non-residents as such. Even there will be certain residents where they have certain income outside India and they will have a tax deducted at that particular country as such. So there also we need to see how this foreign tax credits will come into play. So we may have to take credit of those taxes that has been deducted abroad and then calculate the taxes for the residents. After this session, we have equalization levy. By this time, all of us should have been aware of that equalization levy because of this e-commerce transactions. It started with online advertising, and then now even for e-commerce transaction it has come. So we'll be dealing with the equalization levy 1 and equalization levy 2 by PVSS Prasad, who will be joining us by 5:30. Today we'll be learning foreign tax credit and the equalization levy. Once again, I welcome each and every participant for this particular program, and also welcome Krishnan, and request Pranendra, the treasurer, to introduce the speaker and hand out the proceedings to Mr. Krishnan. Thank you.
Thank you, sir. So I welcome once again all the panelists and also all the members for today's virtual session. First session is on foreign tax credit, which is handled by CAS Krishnan, sir. So to give a brief introduction, He is an international tax professional with significant on-ground practical experience of globalizing a company's operation. He has managed the entire gamut of planning, compliance, tax audits, and litigations in international income tax and transaction tax, due diligence, and contract structuring, as well as risk mitigation. He has also published an elaborate discussion paper on drafting foreign tax credit rules in India. He has written various articles on the onerous reporting requirements in the US on its citizens and green card holders residing outside the US and on taxation of alternate investment funds in India. He's also authored a book on investing in Indian and foreign startup companies, providing an overview of income tax consequences and foreign requirements in India. He is a founder member of International Tax Research and Analysis Foundation, ITRAF, an independent and exclusive forum for tax policy research, analysis, and support conducting research and analysis on in important tax matters, including those relevant to India. He was earlier Vice President and Group Head of International Taxation at Infosys. Over a period of 15 years at Infosys, he has set up an centralized international tax department in Bangalore to manage tax compliances in over 30 countries across North America, Europe, Asia Pacific, Africa, and Russia. With this brief introduction, I welcome today's speaker, CAS Krishnan sir, and over to you, sir.
Thank you, Manindra. Thank you, Mr. Shetty. Thank you, Prasad Srinivas. Before I start my presentation, I want to take a minute to compliment and congratulate Kota Srinivas for organizing this wonderful program. I have been participating in all the sessions so far, and I think it has been extraordinarily done. Particularly the choice of all the speakers that we have had has been extraordinary. They're all people with a great degree of knowledge and experience. So I want to congratulate you, Kota Srinivas, for this wonderful program. And of course, whatever support you want in this regard, we will provide. Now, there is another, you have been talking about my topic. Let me just load my presentation. Okay, so you have been talking about foreign tax credit, but if you look at my my presentation, I am not going to speak only about foreign tax credit. I'm going to speak about the methods for elimination of double taxation, which is a little more broader compared to foreign tax credit. Foreign tax credit is only one of the methods of elimination. So let us look at it in a more holistic manner. Now, when we are talking about methods for elimination of double taxation, it clearly indicates that there is going to be a double taxation which needs to be eliminated, and it indicates that there are various methods of eliminating the double taxation. Before we look at all of these things, it will be useful for us to look at what is the taxation of income in India. We all know that the basis of charge. We all know that the basis of charge of income tax, Section 4 of the Income Tax Act covers that. Income tax, basically, if you look at Section 4, it says that every person shall pay income tax in India on the total income of the previous year. And this income tax can be paid either through a withholding tax or through a advance tax. There's a definition of person which basically includes an individual, HUF, company, firm, AOP, and body of individuals. All of you are very familiar with this, but it is important for us to understand this background before we go into double taxation. Previous year basically refers to the financial year in which the income is earned. Section 5 of the Income Tax Act. The Income Tax Act, just 1 second. Okay, Section 5 of the Income Tax Act basically talks about the scope of income, total income. So if you look at the total income of a resident, it includes income from whatever source derived, which is received or deemed to be received in India, accrues or arises or deemed to accrue or arise in India, and accrues or arises outside India. So these are the three broad categories of income which will be taxable. And in the case of a non-resident, it includes basically received or deemed to be received in India, or accrues or arises or deemed to accrue or arise in India. It does not include the foreign source income. So essentially, there are two sources of income for a taxpayer a domestic source income and a foreign source income. Of course, in the case of a resident but not ordinarily resident, he will be taxed as if he is a non-resident, except for income which is controlled from income from business or profession, which is controlled from India. So more or less, it is like a taxation is like a non-resident. So in case of two sources of income, which is domestic source income and foreign source income, the first two, the non-resident is taxable only on domestic source income, whereas the resident is taxable on global income, which is domestic source income and foreign source income. Now let us look at double taxation. Now, when we look at double taxation, there are two kinds of double taxation. The first one is referred to as an economic double taxation, and the other one is referred to as a juridical double taxation. Economic double taxation arises when two different persons are taxable on the same income. This will be essentially in the case of a corporate tax paid by companies pay corporate tax on their profits, and distribution of such profits in the form of dividends is again taxed in the hands of the shareholders. So basically, two different people are taxable in respect of the same income. Whereas if you look at juridical double taxation, which is what this entire presentation is going to cover, the same income or capital is taxable in the hands of the same person by more than one country. So this is where the juridical double taxation arises. It arises when a residence country, emphasis is on the residence country, it taxes the worldwide income, which is domestic source income and foreign source income, as is the practice in India, and majority of the countries follow this, of its resident taxpayer, and the foreign country taxes the foreign source income of that taxpayer considered to be a non-resident taxpayer in that country. So this results in double taxation of the foreign source income in the residence country. So this is where the double taxation arises. Now let us look at the elimination of double taxation. There are methods for elimination of double taxation. Many countries provide unilateral relief from double taxation through domestic law. India also provides unilateral relief through sections 90, 90A and 91. Section 90 and 91 are more familiar, and that is what is generally discussed about. 90A is generally ignored. In addition, TTAAs, the double tax avoidance agreements, provides a mechanism to eliminate double taxation of the same income in two countries, and that is why it's called as a bilateral relief, because there is an agreement between two countries. Whereas in the case of a unilateral relief, it is basically the country decides what is the kind of relief that it wants to give it to its tax residents or taxpayers. Article 23 of the United Nations and the OECD Model Tax Conventions. In both of these model tax conventions, the Article 23 is common so far as providing methods for elimination of double taxation. So there are two methods of elimination under both of this model. One is called the exemption method and the credit method. Fundamentally, the difference between these two methods is one method looks at, the exemption method looks at exempting the income from taxation, whereas the credit method looks at providing a credit for double taxation. So this is the fundamental difference. Let's examine this a little more in detail because there are variances of this. Now, methods for elimination of double taxation. The exemption method. Under the exemption method, there is a full exemption and there is an exemption with progression. Basically, under the exemption method, the income is exempt from taxation in the residence country. Whereas under the credit method, there is something called as a full credit and ordinary credit. And this is a tax approach. So to that extent, when you have a worldwide income, you get a tax, you pay a tax on the worldwide income and you get a credit for the taxes paid in the foreign country. So let us examine the nuances of the credit method of elimination of double taxation. Under the credit method, the residence country includes the income from source country in the total taxable income of the taxpayer and calculates tax on such taxpayers' worldwide income. We saw section 4 and section 5. So in the case of a resident, he is taxable on domestic source income and foreign source income, which is worldwide income. So first tax is computed on the worldwide income, and then a credit is given for the taxes which is paid outside India. So always under the foreign tax credit or under the double tax credit or under the methods for elimination of double taxation, the residence country is important in providing the credit or the elimination. The source country only taxes, the residence country provides the solution or whatever the mechanism of of taking away the double taxation. Now, the residence country allows a credit or deduction from its income taxes. This is the terminology which is used. So when you're talking about a credit or a deduction, it's a deduction from income taxes and not from income for taxes paid in the source country. Again, there are two methods of providing credit to the credit method. One is a full credit method where all the taxes that you have paid in the foreign country, you can take a credit in the residence country. Whereas in the case of an ordinary credit or a proportionate credit method, it's restricted only to the extent of taxes payable in the residence country on the source income or the taxes paid in the source country, whichever is lower to that extent. What does this mean? If the income tax rate in the source country, which is in the foreign country, is higher than the income tax rate in the residence country, under the full credit method, the residence country will use the income tax collected on domestic source income to provide foreign tax credit. Let us for a moment assume that the tax rate in the United States is higher than in India. So to that extent, let us assume that the tax rate in the United States is 35%. The tax rate in India is 30%. So there is an excess of 5%. Under the full credit method, India will give credit to that extent of 35%, even though it collects only 30% of taxes, which means that the taxes collected on domestic source income is used to provide the relief for foreign tax credit to that extent. Whereas under the ordinary credit method, the methodology of computing is basically many of the countries use the ordinary credit method. The methodology is restricted to tax payable in the residence country at the rate on the income or the tax paid in the foreign country, whichever is lower to that extent. So to that extent, there is no subsidizing the foreign source income, the foreign taxes by the Indian taxes to that extent. India follows the ordinary credit method under the Income Tax Act 1961 and in majority of its DTAs. I am only using majority, not in all the DTAs. For instance, in India has adopted full credit method in its DTA with Namibia. So to that extent, whatever taxes which is payable in Namibia, you are able to take a full tax credit. You don't have to do the mechanism of computation of foreign tax credit to that extent. Now let us look at methods for elimination of double taxation under the exemption method. Under the exemption method, country of residence, which is India, for instance, does not tax the foreign source income, which according to a DTA may be taxed in the country of source. Basically, this is a very simple mechanism. The country says, I don't care about any foreign source income. If you are earning income in this country, you pay taxes on this income and be done with it. We don't want to do any computation and things like that. Now, again, here also you have two methodologies. Under the full exemption method, basically the entire foreign source income is exempt from taxation in the residence country for the purpose of taxation. Whereas in the exemption from progression, even though the income is exempt, for computing the tax rate, which will be applicable for other sources of income, the exempt income is considered to that extent for determining what is the appropriate tax bracket to that extent. Now, let us look at whether all of these things are theoretical or it is practical. So let us look at some of the treaties that India has concluded. Austria, Belgium, Switzerland, and Turkey, for instance, these are some examples. Use a combination of exemption with progression method and ordinary credit method to eliminate double taxation under the treaties with India. So here in this instance, these four countries use this combination of exemption with progression and ordinary credit method, whereas India continues to use the ordinary credit method to that extent. So the foreign source country uses a different methodology for providing double tax relief. India is using a different methodology for providing a tax credit. In India, Poland DTA, both countries had earlier adopted ordinary credit method for certain of its income, for dividends, interest, royalties, and fees for technical services. For these four sources of income, they had adopted ordinary credit method and exemption with progression method for all other items of income. Both the countries had adopted this. From 1/4/2015, both the countries have adopted ordinary credit method for all items of income. Now, in the case of Greece, India uses the exemption with progression method. We talked about Section 4, Section 5, where we are talking about global income. In this particular case, even though India follows the worldwide tax system, in the India-Greece treaty, it provides that income from sources within Greece which under the laws of Greece and in accordance with this agreement is subject to tax in Greece, either directly or by direction, shall not be subject to taxation. So in the case of Greece, India has adopted not the ordinary credit method, but the exemption with progression method. Now, in the case of Austria, India-Austria DTA, again, it uses a combination of exemption with progression method and ordinary credit method to eliminate double taxation. In the case of India, it is ordinary credit method. India shall allow as a deduction from the tax on the income of that resident an amount equal to the income tax paid in Austria, whether directly or by direction of tax at source. Such amount shall, however, not exceed that part of the income tax as computed before the deduction is given, which is attributable. So India follows the ordinary credit method, whereas in the case of Austria, for certain items of income, which is generally dividends, interest, royalties, and capital gains, they follow the ordinary credit method. And in all other sources of income, particularly the business income, they follow the exemption methodology to that extent. Even in the case of exemption, while calculating they take the progression. It is this exemption is by progression, because in calculating the amount of tax on the remaining income of such resident, Austria takes into account the exempted income. So this is how the treaties talk about elimination of double tax credit. Largely, India follows the double tax credit, and that is why I wanted to talk about the methodology for elimination of double tax, not just on foreign tax credit. Now, what is the impact of all of these methods? If you follow the exemption method, it results in the lowest amount of tax payable for the taxpayer. What does this mean is, they are not considering anything relating to foreign source income. Whatever is the tax rate in that country, you pay taxes in that extent. But the exemption method may result in double non-taxation, particularly when the source country provides tax incentives to that extent. Anyway, that income is not taxable in the residence country. So in the source country also, if there is an exemption to that extent, it results in a double non-taxation. Exemption with progression may increase the domestic tax liability, basically because you are considering the exempt income for computing the rate which will be applied on the rest of the income. Under the ordinary credit method, it is the most commonly used methodology in DTAs. Under the ordinary credit method, it is very important to understand that the total tax cost to a taxpayer is higher of residence country tax or source country tax to that extent. So because if you are paying higher tax in the source country, DTA, the credit is limited to that extent of the tax payable in the residence country. If the source country taxation is lower, anyway you pay the taxes as per the residence country to that extent. So under the ordinary credit method, the total tax cost to the taxpayers is higher of either of the countries, whichever is higher. Now, foreign tax credit regime in India. So let us look at what is the foreign tax credit regime in India. The methods of tax credit in India, Section 90 of the Income Tax Act and Section 91 of the Income Tax Act. Section 90 will apply if there is a double tax treaty. Section 91 of the Income Tax Act will apply if there is no treaty which provides a unilateral tax relief. Let us look at both of these sections and see whether it addresses the issues relating to foreign tax regime in India. Now, Section 90 Income Tax Act, Double Taxation Relief. This is the title of the section. It talks about agreement with foreign countries or specified territories. I believe at this point in time, India has concluded somewhere around 94 double tax avoidance agreements with countries outside India to that extent. So it covers a large number of countries with which India has international trade and commerce. I would imagine that more than 90% of the foreign tax credit is covered through the DTAs. Now, what does Section 90 basically says is it empowers the central government to enter into an agreement with the government of any country outside India or a specified territory outside India. What is the purpose of this double tax avoidance agreements or this agreement that they're talking about? The first one is for granting of relief in respect of income on which have been paid both income tax under this act and income tax in that country. So basically what it talks about is providing relief in the circumstances where tax has been paid in two countries. The second category is income tax chargeable under this act under the corresponding law enforced in that country or specified territory, as the case may be, to promote mutual economic relations, trade and investment. So one is for the granting of relief. The second one is for the avoidance of double taxation of income under this act and under the corresponding law enforced in the other country. This is the second purpose. The third purpose is for exchange of information for the prevention of evasion or avoidance of double taxation. This was under a great, this was in the radar of the central government when they wanted to crack on the corruption issues and black money which has been hoarded outside India, particularly in Switzerland and things like that. So at that point in time, it was looking at exchange of information for the prevention of evasion and avoidance of income tax. And the last one is recovery of income tax under this act. This is very, very important. For instance, if there is a foreigner who comes to India and does not pay the appropriate amount of taxes which is due in India, then the government of India is able to recover those taxes with the corresponding country, whichever the country that it has a double tax avoidance agreement, and recover the taxes which is due to India through the government of that other country. Now, so this is the 4 different purposes under which the double tax avoidance agreements or any other agreements can be entered into. The second subsection of section 19 talks about the provisions of this act shall apply to that extent that they are more beneficial to the assessee. So to that extent, either the double tax avoidance agreement, does the double tax avoidance agreement override the central the income tax regulations? No, they coexist, except that the remedy or the relief that an assessee can get can be something which is to this beneficial. There was a great amount of discussion yesterday by Bala, who talked about whether you should be able to take the benefit of the Income Tax Act or the benefit of the double tax treaty and some of the circumstances in which it can be done. So this is a very important point where the central government has entered into an agreement for granting of relief of tax or avoidance of double taxation in relation to the assessee to whom such agreement applies. The provision of this act shall apply to that extent they are more beneficial to the assessee. But in the case of GAR, this provision will not apply. GAR will override to that extent. So the treaty will, the GAR will override the treaty to that extent. Now, for the removal of doubts, the explanation talks about if you look at the income tax rates in India, the foreign company or a foreign branch is taxable at a higher rate. So there is a clarification which says that it shall not be regarded as less favorable charge or levy of tax in respect of such foreign company. Kota, why the rate of taxes for a foreign branch is higher than for a domestic company in India?
Which one, sir?
See, in India, the rate of tax for all the companies is a particular rate. Now we have 30% is there, 25% is there, 22% is there, and then 15% is there. Whereas in the case of a branch of a foreign company, I believe it is 40%. Is that correct?
40%. Foreign company.
40%.
Yes. Yeah.
Do you know why it is 40%? Why should it not be 30%?
Why? Okay. Why I'm not aware. Why it should be 30%? Why not 40%? But I know that it will not amount to non-discrimination is what I understand. Yeah.
So section 90 clarifies that. For the removal of doubts, it is hereby declared that the charge of tax in respect of a foreign company at a rate higher than the rate at which domestic company is chargeable shall not be regarded as less favorable charge or levy of tax in respect of such foreign company. The reason why a branch is taxed at a higher rate is basically because of compensation towards dividend. Let me explain. Now, if a subsidiary is operating in India, a subsidiary will be a subsidiary of a foreign company, will be a domestic company in India. So they pay taxes at the regular rates, which is applicable to a domestic appropriate tax rate. When the subsidiary pays dividend, there is a withholding tax in India on the dividend paid to the foreign company to that extent. So both of these rates together is what the foreign branch faces by way of a higher tax rate. For instance, when many of the Indian companies operate outside India, and some of the countries we have to pay, particularly in the United States, in addition to the federal income tax, state income tax, local income tax, we also compute something called as a branch profit tax. Even in the case of Canada also, there is a computation of branch profit tax to that extent. So combined together, the rates will obviously increase. In the case of India, they have chosen not to charge two different rates at two different points in time, but combine it so that the rate is higher for a foreign branch. This is the reason why it is there. And this particular act, where a section clarifies that it should not be regarded as less favorable charge or levy of tax in respect of such foreign company. And there is a terminology used in the treaties which is specified territory, which means any area outside India which may be notified as such by the central government. So these are the highlights of section 90 to that extent. Now let us look at section 91. It will apply in the case of countries where there is no treaty, where the agreement exists. If a person who is resident in India, if he proves that he has earned income which has accrued or arise outside India during that particular year, and he has paid in that country any tax, and if there is no double tax avoidance agreement, then section 91 will provide relief. It says that he will be entitled to the deduction from the Indian income tax payable at the rate whichever is lower to that extent. So whatever the provisions of the treaties which is provided, he shall be entitled to the deduction from the Indian income tax at a rate whichever is lower. Foreign tax payable or Indian tax payable, whichever is lower, is the mechanism under which section 91 talks about in the case where there is an agreement. In the case of those 94, 95 countries where India has entered into an agreement, anyway you get the relief through the treaty. There is a unilateral tax credit which is section 9091. And then in the case where there is no treaty, then section 91 will apply. Now section 91(2) talks about agricultural income to that extent, particularly from Pakistan. Now, this is a case where a non-resident, if is assessed as a resident in India for any reason, then also such a person, because he's been assessed as a resident in India, he'll also be entitled to take the credit because he's paying taxes on his global income. And if there is a double taxation, he'll be able to take credit to that extent, as long as he proves that he has paid income tax by deduction or otherwise under the law enforced in that country. There are some explanations which has been given, which explains what is Indian income tax, how to compute Indian rate of tax of the said country. This is all under section 91. The expression income tax in relation to section clause 4 is very important. It says expression income tax in relation to any country includes any excess profit tax or business profit tax charged on the profits by the government or any part of the country or a local authority in that country. Is this clear, Kuta, so far? Hello?
Yeah.
Okay. Do you have any questions?
No, as of now, I don't see any questions.
Okay. Now let us go back to section 90 and 91 because this is the unilateral tax credit. Now, if I look at section 90 and 91, nowhere it talks about how do you take credit. What are the circumstances under which you take credit? What are all the types of taxes that you take credit? What are the types of taxes in India against which you can take credit? It only gives you the philosophy of how to take double tax relief. And that is where the problem is, because with section 90 and 91, even though it is unilateral tax credit, you will not be able to compute. You will not be able to. We talked about the 4 mechanisms of elimination of double taxation, which is the credit method and the exemption method. Which method should be applied? Section 90 and 91 does not talk anything about it. And that is where the problem is, because you have to depend only on the treaties for double tax credit. So you have to go to each and every treaty where you are earning income, determine what is the treaty which what it talks about, and see if you are able to take credit. Even the treaties only give you certain methodology. It only talks about whether you want to do it under the progression method, whether you want to do under full credit method or under the ordinary credit method, those kind of methodologies. It does not address many of the practical issues of how to take a credit. And that is where this lacuna has been. So to some extent, this has been redeemed when they introduced the foreign tax rules in India. The foreign tax credit rules were introduced in April 2017. Since it is called foreign tax credit rules, there is no reference to exemption methodology of redemption of double taxation in India to that extent. Now, this foreign tax credit rules tells you how to take the foreign tax credit. The first rule is An assessee being a resident, he shall be allowed a credit for the amount of any foreign tax paid by him in a country or specified territory outside India. So if you are a resident, you are allowed a credit for the amount of any foreign tax paid. In the case where income from on which foreign tax has been paid or deducted is offered to tax in more than 1 year, this will generally be the problem where many of the countries outside India follow a calendar year basis. We follow a fiscal year basis, which is April to March. So to that extent, there will be an overlap. So if the same income is offered to tax in 2 different years, then the foreign tax credit shall be apportioned in the ratio in which the income has been apportioned. So this is the fundamental rule under which the foreign tax credit is computed. The foreign tax referred to in subsection 1 shall mean tax covered under the said agreement. Under section 90A, the tax covered under the said agreement in the case where there is an agreement. In the respect of any other country or specified country, tax payable under the law in force in that country or specified territory in the nature of income tax. This is very important. In the nature of income tax referred to in clause 4 of explanation to section 91. Section 91(4), we saw that it talks about what are the kinds of taxes that it can be against which the tax credit can be claimed. The credit under sub-rule 1 shall be available against the amount of tax, surcharge and cess payable under the Income Tax Act, but not in respect of any sum payable by way of interest, fee or penalty. So when you're taking credit in India, against what do you take credit? You will take credit against the income tax that you pay. We have a surcharge and we also have a health and health cess at this point in time. So we can take credit against the combination of all of these three, which is income tax, surcharge and cess, but if not by way of interest, fee or penalty. So if there is any interest, fee or penalty that you pay, you can't claim credit against them. No credit under sub-rule 1 shall be available in respect of any amount of foreign tax which is disputed. For instance, when you are operating in a foreign country, if there is a litigation on a certain portion of income, you cannot claim credit to that extent, basically because tomorrow if the dispute is settled in your favor, you are not paying taxes in that country, but you will be taking credit in India. So to that extent, any disputed tax, you can't take credit in India till such time that dispute is settled. In the year in which the dispute is settled, if you are able to prove to the authority that dispute is settled and then you have paid taxes in that country, you are then entitled to take credit to that extent. Now, FTC, how is FTC computed? This is extremely important. We will examine this a little more in detail. It is basically the aggregate of amounts of credit computed separately for each source of income arising from a particular country or specified territory outside India. This is how it talks about where foreign tax credit exceeds the amount of tax payable in accordance with the provision, such excess shall be ignored for the purposes of this particular clause. We will examine this in detail, but I'll just repeat this because this is very important. There are two methods of claiming tax credit. One is a pooling method and one is what is a computation under a particular head of income. Now, under the pooling method, what it means is all the income that you earn in a particular country, you pool together, compute the aggregate, the effective tax rate, and then you take credit. Because of which what happens is, if you are paying taxes, if a certain portion of income is taxed at a higher rate, and if a certain portion of income is taxed at a lower rate, the aggregate will be to that extent lower to that extent. Whereas if you're talking about a computation on for each separate source of income particularly, then what happens is the amount of credit that you will get will be limited to that extent. We will see the impact of this in terms of an example later. In case, for instance, the foreign tax that you have paid is more than the domestic tax, what happens to such foreign extra foreign tax? Are you able to take it forward or are you able to take a deduction? The credit rules particularly clearly talks that such excess shall be ignored for the purpose of this particular clause. There is a mechanism of how to use the conversion rate. So you have to use the SBITT telegraphic buying rate to that extent. If any tax is payable under 115 JB, 115 JC, which is the alternative minimum tax, the foreign tax credit cannot be taken against alternative tax credit. It should be taken under the normal tax credit to that extent. It shall be allowed. You have to provide some documents. for claiming the foreign tax credit. Now, so to the extent, the sum and substance, if I have to talk about so far, it talks about how to take foreign tax credit. Now, the issue that I have with foreign tax credit rules is it only talks about the tax regulations relating to India. It doesn't talk anything about the foreign taxes outside India. So it doesn't talk about what are the kinds of taxes on which we can take credit and what are the methodologies of computing foreign tax credit and things like that. It only talks about this particular foreign tax in India, if you see what it talks about. So this is a little better than section 1991 because it provides some framework for computing foreign tax credit rules, but to my mind, it is not adequate to that extent. So if you see this concept of research we had so far, it gives an intent saying that if there is an income which is suffering double taxation in terms of tax paid in the foreign country and usually in India. Is that I have to refer back to you, Kotha, because not to the extent. So taxes in India, foreign tax. Kotha? Or anybody
Hello?
else? Sorry?
Yeah. Tell me.
Can foreign tax credit be taken against exempt? You pay taxes outside India. Let us say you pay taxes in the United States of America. Okay. Now in India, you don't pay taxes. You are exempt from paying income tax because of certain benefits that you get under section 10A or any of the exemptions to exist. So when you are exempt from paying taxes in India, can you claim foreign tax credit in India?
No, you cannot claim.
What I have explained so far is foreign tax credit can be claimed if the same income is taxed in both the countries. In this case, this income is not taxed in India because it is exempt.
So there is no question of claiming refund of the taxes which you have paid to some other country. So you cannot claim that and claim it as a refund. Hello, am I audible? Hello?
Sorry, you can't claim it as a refund.
Yes, it is audible.
Yes.
Yeah, you cannot claim. When once you're not offered that income to tax in India, there's no question of you claiming that taxes that you have paid outside in India.
Okay.
And even as you said,
So,
most of the
let us examine a particular High Court decision in this regard. Now, can foreign tax credit be claimed against exempt Indian income? So we are talking about a Karnataka High Court decision, particularly in the case of a Bangalore-based company. I do not know if PVS or Bala is there in this conference. It would be nice if particularly PV Srinivasan is there, because he has worked extremely hard on this particular issue. Wipro Limited, like many other software companies, it operates through a branch structure in countries outside India, predominantly the United States, UK, Canada, Japan, Germany, and many other countries. Consequently, it has permanent establishment in those countries. It computes the profits attributable to those PEs and pays applicable income tax on such profits as required under the domestic tax laws of these countries. I am reminded of the days when I spent in Infosys doing all of this computation and filing the income tax return in almost over 30 countries every year. Wipro is also eligible for tax holidays in India for its undertakings under Section 10A of the Income Tax Act. Earlier it used to be 80 HHC, whereas now it is under Section 10A, which is a software technology park exemption. Consequently, it is not liable to pay income tax in India on income generated by these undertakings. while it pays taxes on the on-site income that it generates outside India because of the regulations in each of those countries outside India. It is exempt from paying taxation in India because of the exemption under Section 10A of the Income Tax Act. So even though Section 10A gives them the exemption, they are eventually paying taxes on a certain portion of its income, which is on-site income. So the issue was whether the foreign tax credit can be claimed in India for the foreign taxes paid against exempt Indian income, and the years of assessment in this particular case related to 2001 to 2005. Now the Income Tax Appellate Tribunal, as Kota says, ruled that no foreign tax credit can be claimed when the assessee is not liable to pay tax in India due to the exemption under Section 10A. Wipro appealed against this. So the observations of the Karnataka High Court in the case of Wipro versus DCA, 25th March 2015. I am just reminded this particular ruling has come in March 2015, whereas we are talking about this litigation relating to 2004-5. It has almost taken 10 years for them to come to this level of a resolution. The Finance Act, and incidentally, this particular ruling has come even before the foreign tax credit rules have been notified in this country, because the foreign tax credit rules was notified only in 2017. The Finance Act 2003, these are the observations of the Karnataka High Court. This is extremely important, and that's why I've taken up early in the presentation. The Finance Act 2003 extended the benefit of granting double tax relief to income tax chargeable under the Act. See, if you see the Income Tax Appellate Tribunal, they ruled that no foreign tax credit can be claimed when the assessee is not liable to pay tax. That is basically the ruling says that you have not paid tax, you can claim credit to that extent. Whereas the Karnataka High Court says the Finance Act 2003 extended the benefit of granting in both the jurisdictions is not sine qua non anymore. It is not compulsory that you pay income tax both for you to claim tax credit. This is the fundamental thing so far, whereas this particular ruling challenges to that extent, it reverses that to that extent. If you go back to what is this Section 90, this Finance Act 2003 that they're talking about, Section 91, the central government may enter into an agreement with the government of any country outside India or specified territory outside India for the granting of relief, which is double tax relief, on income on which have been paid both incomes under this Act and income tax in that country. This specifically talks about income on which has been paid income tax. That means you paid income tax under the Income Tax Act and income tax of the foreign country. This is the first premise, Section 90A1. Section 90A2 was introduced in 2003 with effect from 1/4/2004, where it says income tax chargeable under this Act. It doesn't talk about income tax payable. It talks about income tax chargeable under this Act and under the corresponding law enforced in that country or specified territory, as the case may be, to promote mutual economic relations, trade or investment. So this is the particular section that the Karnataka High Court referred to. So there is not necessary that you have to pay double tax in both the countries to claim a foreign tax credit. Second thing is, the second thing is the benefit under Section 10A, because Wipro was exempt under Section 10A. What is the character or what is the character of Section 10A? What is the nature of this particular exemption? It talks about the benefit under Section 10A is given to a specific STP undertaking and not to the taxpayer per se. In other words, the relief travels with the undertaking. Tomorrow, if that particular company wants to sell this particular STP undertaking, it can do it, and then the exemption goes with the STP undertaking and does not remain with the taxpayer. The first provision to Section 10A1 refers to total income of the undertaking and not to the total income of the assessee. Everything about Section 10A is about the undertaking and not about the assessee. So the computation of relief as provided in Section 10A4 is also with reference to the undertaking. Even 10A2 and 10A3 is also with reference to the undertaking. Now, income under Section 10A. So therefore, the High Court concludes income under Section 10A is chargeable to tax under Sections 4 and 5. This is the basic premise of Section 91A2. It should be chargeable to tax. So the Karnataka High Court observes saying income under Section 10A is chargeable to tax under Sections 4 and 5 of the Income Tax Act, which we examined earlier. The exemption, the Section 10A exemption has the effect of not collecting income tax for 10 years, and it will stand revoked after that period. Therefore, the case falls under Section 90, which is called income tax chargeable under this act to that extent. Now, when an and they give a particular reason, this particular which is 91A2. When an exemption is given under the Act, under the Income Tax Act, you give an exemption, and when you give an exemption, it gives you a relief from payment of taxes. Income tax foreign jurisdiction, you don't have to pay any taxes. Because you are operating in a foreign jurisdiction, you have to perforce pay taxes in that particular country. So to that extent, the full benefit of the exemption given under the Act is not taken by the assessee because he is paying taxes in the foreign country. Therefore, to promote mutual economic relations, trade and investment, the Act was amended by Finance Act 2003. The statute, but however, the statute by itself is not giving any relief. By virtue of the statute, if there is an agreement and that the agreement provides relief, then the assessee would be entitled to such relief. Now let us look at this particular issue in further detail. His ruling is not absolute. The Karnataka ruling, High Court ruling is not absolute. It has to be read in the light of the relevant treaty. So what it says is if the treaty gives you a benefit, you can take the treaty benefit to that extent. Now let us look at Article 25 of the India-US Treaty, which is about elimination of double taxation. Article 25(2)(a) says where a resident of India, how do you compute double tax credit? This is very important because many of the treaties will tell you how to compute double tax. In this particular instance, in the case of 25, which is about relief from double taxation, that is the title of this article. Article 25(2)(a) says where a resident of India derives income, which in accordance with the provisions of this convention may be taxed in the United States, India shall allow as a deduction from the tax on the income of that resident an amount equal to the income tax paid in the United States, whether directly or by deduction. So basically what this particular article talks about is, it does not say that this income should be taxed both in United States and in India. It says if you have paid taxes in the United States, India shall allow as a deduction from the tax on the income of that particular residence. And that is what the Karnataka High Court is referring to. Whereas if you look at the benefit under Article 23 of the India-Canadian DTAA, it will be available to an assessee in India only if the assessee, this is under the treaty, only if the assessee has paid tax both in India and Canada. So if you look at Section 90, Section 91A has got two subsections. One of that is covered under the US treaty, one of that is covered under the Canada treaty. The first one, Section 91A1, income on which have been paid both income tax under this act and income tax in that country. This is what is covered by India-Canada treaty, whereas income tax chargeable under this act and under the corresponding law enforced in that country is what is covered under Article 25 of the income tax of the India-US treaty. So to that extent, you can take credit to that, even though you don't pay taxes in India under Section 10A, you will still be able to get a credit to that extent, whereas you will not be able to get credit under the India-Canada TTA. This is the basic ruling to that extent. So even though we believe that double tax credit is applicable in a particular format, this particular High Court decision is very important because an entity which is not required to pay taxes in India, they will be able to get credit in India from the domestic taxes either paid by the same company on its other income or paid by some other companies on their domestic source income. So the domestic source income is subsidizing the foreign tax rate to that extent of amount which is repaid to the company. Now let us look at these foreign taxes which are eligible for credit in India. I made a remark saying that
Krishnan.
Yeah.
Yeah, this what you explained, that particular case is with respect to entity where it has got other income and also an exempted income, that is under STPA. If I take a general example, say like an individual who has got some foreign income and he has got some foreign tax credit or foreign taxes, but when he comes and has to calculate his income in India, and if it is exempted or because of the basic exemption limit or some rebates and all, if it is exempted, I cannot claim the credit and get the refund. Is that correct?
Yeah. So basically, see, the computation of tax for an individual is you take the 5 heads of income, which is salary income, house property, income from profession on business, and then capital gains and other income, and you compute the total amount of taxes. And then from that, whatever exemption that you get, whatever deductions that you get, for instance, ATC you get, for instance, if you have made some donations, you get ATG. All of those exemptions you reduce. For instance, if you have a housing loan, then you take credit to that extent of interest on housing loan and principal of housing loan, whatever. You compute what is the total amount of taxes payable in India on your global income. That is the first thing. And then when you're taking credit, you take credit against the total taxes payable. So wherever any exemption you get, you don't get any exemption. Essentially, whatever deduction that you get, particularly ATC, ATG, and all those things, it is reduced, and from that tax, you will get a foreign tax credit to that extent.
No, that's what. If my foreign tax credit is more, I cannot claim it as a refund. That's what I want.
No, you can't. You can't.
Yeah.
Because I will come back to that particular thing, but you can't claim a refund. Okay. Okay. That's why. Okay. This is very, very important. Foreign tax credit rules 5(1). Credit shall be lower of the tax payable under the Act on such income and the foreign tax paid on such income. This is the fundamental rule of ordinary tax credit. Where the foreign tax paid, which is what you're talking about, exceeds the amount of tax payable in accordance with the provisions of the DTAA, such excess shall be ignored for the purpose of this clause. When you're talking about ignored, you won't get any refund.
Correct.
Okay. Anything else? Is there anybody else who has got any questions? Now I will go to the foreign portion of the taxes. That's why I'm asking this question. So far, we have covered everything relating to India. Okay. Shall I continue?
Yeah, go ahead.
Okay. This is very, very important. Foreign taxes eligible for credit in India. Today, when you're talking about foreign taxes, this is where our experience, particularly my experience.
Sorry, Krishnan, there are 2 questions. If you can just take that in question and answer.
You tell me and then I'll decide.
Yeah,
you tell me, let me decide.
If you have covered this, you take. Otherwise, you can take afterwards. To the extent of tax credit not available for relief, whether the same can be claimed as expenditure.
Good question. I will answer.
Okay. How about a scenario? How about a scenario where the domestic income is negative and become positive income only because of foreign income?
This is a question which is repeatedly asked. I will address the issue also.
Okay, you can go.
Now, foreign taxes eligible for credit in India. Now, this is where my experience of managing global taxation is there. When we operate in various countries, different countries have different kinds of taxes. So basically, India follows a federal structure towards imposing. So for instance, we don't pay taxes in Karnataka. We don't pay income tax in Karnataka. We don't pay income tax in Bangalore. We may pay various other taxes, but we follow a federal structure towards imposing income tax. Some countries follow a federal and regional structure to impose income taxes, particularly the United States, Canada, Switzerland, Germany. Income taxes in Switzerland, they are levied at a federal level. Basically, if you look at Switzerland, it's basically a consortium of various cantons. That's what it is. At a federal level and also by the cantons. Cantons are equivalent to states in India. Based on the tax laws of their canton, the communes also levy income taxes. The communes are equivalent to our cities. So in Switzerland, you have a federal income tax, you have a cantonal tax, and you have a commune taxes. All of this are something which is all income taxes to that extent. So the cantonal tax is specific to each of the 26 cantons. There are 26 cantons in Switzerland, which makes up the total Switzerland. And commune taxes are also added to the canton tax with varying rates according to the wealth of the community. As per Article 2, see today if I look at Section 90, 91 and the foreign tax credit rules, I do not know whether I take credit for these taxes because they don't address, that is where the problem is. They don't address what are the kinds of taxes that I am required to pay outside India and I can take credit in India. I have to per se refer to the treaty to that extent. Now, if you look at Article 2, every article in a double tax avoidance agreement will talk about the scope of the treaty. This is very important. It talks about the scope of the treaty. At the beginning itself, it says where it applies, where it does not apply, what it applies to, what it does not apply to. As per Article 2 of the, generally Article 2 is of any treaty will cover this. As per Article 2 of the India-Switzerland Treaty, the taxes to which this agreement shall apply in the case of Switzerland are very specifically federal, cantonal and communal taxes. All of this together, I can take a tax credit in India against my income tax, against my surcharge and against my cess. So very clearly to that extent, there are no complexities when I pay taxes in Switzerland. If tax rate in Switzerland, combination of all of this is high, the combination of income tax and cess, then I will not be able to take the excess to that extent. If it is lower, then I'll get full tax credit to that extent. So to that extent, I will pay higher of domestic tax rate or foreign tax, whichever is higher. As the India-Switzerland Treaty includes cantonal and commune taxes on income, income taxpayers are eligible for foreign tax credit in India. So this is very simple scenario. A similar situation also prevails in Germany. In the case of Germany, just like you have in Switzerland, you have a corporate tax rate which is 15%. There is something called as a solidarity charge, which is, these are all fixed rates. Corporate tax rate is 15% and you have a solidarity tax which is 5.5% of the normal tax rate. So the corporate tax rate in Germany is 15.825%. This tax, the solidarity tax, is basically for merger of the East Germany and West Germany after the war that they had. In addition, there is a municipal trade tax of 14 to 17% that is imposed by a municipality. So each of the municipality have their own rates. The rates vary between 14 to 17%. So the effective tax rate, so if you add 14% to 15.825, it will be somewhere around 30 to 33% depending on the municipality where you operate. As per, just like the Switzerland Treaty, as per Article 2 of the India-Germany Treaty, this agreement shall apply to taxes on income and on capital imposed on behalf of a contracting state. This is the language that they have used. So taxes on capital imposed on behalf of a contracting state or a political subdivision or local authority thereon. So you can claim credit as the India DTA, Germany DTA includes taxes on income imposed by a political subdivision or a local authority. You get credit for municipal trade tax as well as for the corporate tax rate of 15.825. So just like in the case of Switzerland, you are able to get the full tax credit subject to the tax rate in India being higher than the tax rate in Germany. If the tax rate, the overall tax rate is higher than the tax rate in India applicable to that particular income, then the excess shall be ignored as per the foreign tax credit rules. Now let us look at this United States of America, where the highest amount of trade happens from India. Income tax in the United States is imposed at 3 levels. One is the federal income tax, which is imposed by IRS. The various states there are 50 states. Majority of the states impose. There are maybe about 8 to 10 states which don't impose any income tax. So most states and some local governments. So if you operate in New York, you have to pay New York City tax. If you operate in California, you have to pay city tax. So the tax rates could range between 3 to 10% depending on the states and the cities in which you operate. Unlike in the case of Switzerland and Germany, if you look at Article 2 of the India-US Treaty, the existing taxes in the United States to which this convention shall apply are federal income taxes imposed by the Internal Revenue Code. It is only federal income taxes. It does not talk anything about state or city tax. Consequently, Indian companies are unable to avail foreign tax credit in India on the income tax paid in the various states and cities in the United States of America, as they are not federal income taxes imposed by the Internal Revenue Code. Contrary to the other two countries, in the case of United States, you are not able to take foreign taxes, credit for foreign taxes paid in states and local government. This is under the under the treaty, which is covered by Section 90. Foreign taxes eligible for credit in India, which is under Canada. Similar to United States, Canada also have, they have provinces and territories, they have provincial taxes. So as per Article 2 of the India-Canada Treaty, the existing taxes in Canada to which this agreement shall apply, imposed on the Income Tax Act of Canada. Consequently, Indian companies are unable to take foreign tax credit in India and income tax paid in the provinces and territories of Canada, as they are not taxes imposed on the income tax. So consequently, as a taxpayer, our overall tax liability will increase due to our inability to obtain credit in India for some portion of foreign taxes paid. This is where the issue is. And this is where, based on my experience, I had a committee was formed. As I talked about, Section 90 and 91 by itself is of little use so far as computation of any credit mechanism is concerned, because they don't address any of these issues. It was only in 2017 that we have the foreign tax credit rules. So till such time, there used to be a huge amount of issues relating to, you have to go to each and every treaty. Each and every treaty addresses these issues in a different manner. If you take these 4 treaties, there is inconsistency with 2 treaties treating in a different manner, and the other 2 treaties not providing credit for state. So in that context, I had prepared almost a 30-page document. A foreign tax credit committee was formed by the government. I think it was somewhere in 2012. And as part of my initiative, I had prepared a very exhaustive document based on my own experiences of various taxes that we pay, our analysis of the treaties, and I wanted to present this paper to the CBDT and discuss with this committee. I and Mr. T.P. Wastwal went and met this committee. They were extremely reluctant to meet me because they said, we know what to do, why are you coming into? We didn't want to approach through any trade body because they have their own mechanisms of addressing this issue. But somehow we prevailed upon them and we went and met them. The reception that I got in this meeting was extremely cold. I gave them the paper. They were not even interested in looking at this paper, which addresses some of these issues. And then finally, I left the paper with them and we came back. It was an extremely disappointing meeting. The problem that we have in this country is when there are people like me and PV Srinivasan and various other people who have an enormous experience of dealing with tax authorities outside India, when we provide certain inputs, when the government is not even willing to look at it, there are going to be some unintended consequences to a large extent. Now, let us look at this particular issue, how this got resolved to that extent. So in this case, just to continue, if you look at Section 91 of the Income Tax Act, it provides relief from double taxation. Section 91 particularly does not distinguish between state and federal taxes. So the expression income tax in relation to any country includes any excess profit tax or business profits tax charged on the profits by the government of any part of that country or a local authority in that country. But as we know, Section 91 applies only when there is no double taxation avoidance agreement. If there is a double taxation avoidance agreement, we have to go back to Section 90, where some countries provide relief and some countries don't provide relief to that extent. But section 91(4) addresses this issue because it talks about charge on the profits by the government of any part of that country or a local authority in that country. Let us look at this very important decision in the Bombay ITAT decision in DCIT versus Tata Sons Limited. This decision was given, of course, by Mr. Pramod Kumar, who is a chartered accountant, incidentally. Well, so this is the observation of the ITAT decision. The background of this particular case is basically they applied, they sought credit to that extent of taxes paid under section 91, saying that we are not able to get credit to that extent, so give us credit to that extent. If you are not able to give credit under section 91, you allow us to give a deduction to that extent. This were the two submissions that they made. So they have gone into a great degree of detail. Because of lack of time, I've just taken the summary of it. This ruling says, well, section 91 allows credit for federal and state taxes. The DTAA does not allows credit only for federal taxes. This results, the result is that section 91 is more beneficial to the assessee, and virtue of section 92, it must prevail over DTA. Section 92 talks about whichever is most beneficial, they should be able to take either the treaty or the income tax act, whichever is beneficial to that extent. But section 90 does not say specifically that you can take credit for state taxes to that extent. They are silent on this matter, whereas section 91 addresses that. But section 91 operates in a circumstances where there is no double tax avoidance agreement. So the ITAT observes that though section 91 applies only to a case where there is no DTAA, a literal interpretation will result in a situation where an assessee will be worse off as a result of the provisions of the DTAA, which is not permissible under the Act. If you follow the DTA, you are not able to take state tax credit. Section 91 must consequently be treated as general in application, must prevail where the DTAA is not more beneficial to the assessee. So what they are trying to say is, even though section 91 will apply where there is no treaty, because section 91, some of the provisions of section 91 is applicable, and if you had put that those provisions in 90, then you would have got a relief. So we want to treat as if section 91 is applicable in this particular section. Section 91 must consequently be treated as general in application. You can't treat it saying that it applies only in circumstances where there is no treaty. So we want to treat it as general in application, must prevail where the DTAA is not more beneficial to the assessee. Accordingly, and even an assessee covered by the scope of the DTAA will be eligible for credit of state taxes under section 91, despite the DTAA not providing for that. So to that extent, this particular ruling resolves the conflict that we have had in 4 different DTAAs. 2 DTAAs permit tax credit, 2 DTAAs don't permit. So to that extent, this particular ruling is very important. Ideally, what I had proposed in my meeting with the tax authorities is, please be specific in the foreign tax credit rule, saying that if there is any for state income taxes that you pay, you should be able to take credit in India to that extent. This ruling has become a de facto ruling to that extent. Even though the foreign tax credit rules don't mention about it, this has more or less become a de facto ruling, except that this is an ITAT decision, so this can be appealed against and to that extent. So to mitigate this particular thing, I was very keen that the foreign tax credit rules say specifically, particularly the state income taxes should be eligible for credit. In any case, India does not lose anything by mentioning that, because you are getting credit only to the extent of taxes payable in India or outside India, whichever is lower. But this is where this issue is. So foreign taxes, companies are able to take credit based on this, subject to the condition that the tax rate should be lower either in India or outside India. Now let us look at the computation of foreign tax credit in India. How do you compute the foreign tax credit? I touched upon this issue briefly earlier. Now, according to the FTC rules, it talks about aggregate of the amounts. See, till the time that the foreign tax credit rules were introduced, nobody knew how to compute. do you compute it? So today when Infosys was operating in 30 countries outside India, it didn't really matter for a large portion of my time in Infosys because we were exempt under taxes. So we never used to claim foreign tax credit, unlike in the case of Wipro where they claimed against Section 10A. So the issue was, which was an unanswered question, is how do you compute it? So we all went by Section 92 says that whichever is beneficial you do. So we used to do a global pooling. That is, we will take the total income tax that is paid in all the countries outside India, and then we used to calculate the average effective tax rate outside India, and we used to take tax credit to the extent where we can. Now that this rules has come, it says very clearly the foreign tax credit shall be the aggregate of the amounts of credit computed separately for each source of income arising from a particular country or specified territory outside India. I want to emphasize again, credit computed separately for each source of income. Okay, so you have in India, you have 5 heads of income. So you compute separately for each head of income arising from a particular country, country by country, source by source, you have to do it, and shall be given effect to the following manner. The credit shall be lower of the tax payable. I will give an example to explain this. And the foreign tax paid on such income, where the foreign tax credit, foreign tax paid exceeds, which is the question that you asked, Kota, and this is the answer to it. Consequently, there is no mechanism because of this methodology. There is no mechanism to offset the corporate income tax paid in a foreign country under a higher rate with the income tax paid in another foreign country under a lower rate. So this is between countries. Even within the same country, if there's one source of income which is taxed at a higher rate and one source of income which is taxed at a lower rate, you can't combine and take the benefit of it. Particularly capital gains, for instance, they are always treated in any part of the country, in all the countries around the world, at a concessional rate of tax. So to that extent, you won't get the benefit. If you have to see this impact, let us see different sources of income earned by the same country. Let us take an Indian company earns royalty income of for $200 from country X. Business profits determined on a net income basis for simplicity purpose of $300, net business profits from its branch in country X, and dividend income of $100 from its subsidiary in country X. So they have a royalty income which is earned separately. They have a branch where they earn permanent establishment, where they pay taxes to that extent. And in the case of dividend income from its subsidiary, it earns. So company A has foreign source income of $600, 200, 300, 100, 600. Now let us assume country X levies taxes of 15% withholding tax on royalty income. Business profits of a branch are taxed at a 40%. I'm talking about the business profits of a branch at a higher rate because of state as well as income tax, federal income tax, and dividends are subject to 15% withholding. Let us go with these assumptions. So company A is thus subject to foreign taxes of 30 rupees, $30 on royalty income, which is 200 into 15%, $120 on business profits, which is 300 into 40%, and 15% into 100 rupees, $100, which is dividend income. So it results in a total foreign tax payment of 165, which is 30 plus 120, 150 plus 15, 165. This results in an effective tax rate of 27.5%, 165 over $600 on foreign source income. Let us assume the corporate tax rate in India, of inclusive of all the taxes, which is surcharge, cess, everything, is 35%. For simplicity purpose, let us take 35%. India tax liability, because the rate is higher than 27.5, India tax liability will be higher on the foreign source income. So the India tax source income is 210, which is $600 into 35%. So the total foreign tax payable is 165. The India tax liability on foreign source income only is 110. So under the pooling method, if you go under the pooling method, the foreign tax credit will be, you will get full foreign tax credit because the tax that you have paid cumulatively is lesser than the tax payable in India on that particular foreign source income. So you should be getting 165. Now let us look at compute the foreign tax credit under the foreign tax credit rules. Royalty income. Pay taxes of $30 outside India. Domestic tax on foreign royalty income, 35% into 200 is $70. So you get a limitation is only 30. You can take a credit of only $30 because $30 is lower. Foreign tax is lower than India tax. Business profits. Again, you pay foreign tax of 120, which is 40% into $300. India tax on that is 35% into $300, which is 105. So you get a foreign tax limitation of only, you get a credit of only 105, whichever is lower between these two. In the first instance, $30 is lower, so you get foreign tax credit of only 30. In the second instance, even though you pay more taxes outside India, you get a foreign tax credit of only 105. In the case of dividend income, as in the case of royalty income, you will be able to get full foreign tax credit of $15. Now, foreign tax of 165 paid on foreign source income results in effective tax rate is 35%. India tax is 210. Now, India company A's foreign tax credit under the foreign tax credit rules will be limited to 150, which is you get a limitation of 30 plus 105, which is 135 plus 15, which is 150. So the foreign tax credit is limited to 150, even though you have paid 165. Resulting in an incremental tax liability of $60 to that extent. Against this India tax liability of 210. So it results in an incremental tax liability. You have to pay incremental tax of $60 in India, which is $210 to less 150. Even though the ETR on foreign source income on a cumulative basis is at 27%, you are not able to claim full tax credit because the actual income tax liability on business profits is higher than the tax liability in India on such income. Because of that, the taxes that you pay is higher to that extent. Now, the pooling of income from these different sources. The pooling of different types of income will result in adding high tax income or low tax income, increasing the amount of creditable foreign taxes. In this example, if the pooling method is adopted, as I said, you would have got an incremental tax of only 45, whereas under the source by source limitation, you are paying tax to the extent of $60, because if you go back to that example, you have a limitation between these two, between 120 and 105, the difference is 15. You are able to take foreign tax, your credit is limited only to 150, even though you have paid 120. So you end up paying that $15 to that extent, because instead of paying $45, you end up paying tax. The total tax liability of company A will be lower at 210 under the pooling method as compared to the total tax liability of 225 under the source by source. So if you pay taxes under the source by source limitation, you will invariably pay more tax. The worldwide pooling method has the advantage that high tax income and low tax income from all sources in all countries are pooled together, and the total amount of foreign taxes available is lesser to that extent. Now look at this particular country. Of course, it's a very small country. It can't be taken as a, but look at this. Singapore was following the source by source and country by country method, which is now prescribed in India. Singapore has introduced a new foreign tax pooling system introduced in 2012. Taxpayers may elect to pool. So they said either you pay under this methodology or under that methodology, pooling method or by source by source. But they said they have to meet certain conditions. They said that to qualify for the foreign tax credit pooling system, foreign income must meet all of the following conditions. You can't say, for instance, if you operate in a zero tax environment, then you can't club that and take it. So they said income tax must have been paid on the income in the foreign jurisdiction from which the income is derived. You should pay income tax. That is the first rule. The headline tax rate of the foreign jurisdiction from which the income is derived should be at least 15%. There are many countries which are tax havens where the rate of taxes is extremely low. So you can't take benefit of such countries and low taxes that you pay. Headline rate should be at least 15%. And there must be Singapore tax payable on the taxpayer's foreign income. These are the three conditions for you to qualify under the pooling system. So this was the suggestion that I had made to the committee, saying India should follow worldwide pooling method, as a large number of Indian companies, particularly from the software sector, operate in countries through a branch mode. Different countries have different rates, different companies have different profitability and things like that. So a pooling method on a worldwide basis is adoptable, is appropriate for this particular thing. By adopting a worldwide pooling method, Indian companies will be able to offset the high tax income against low tax income, will be able to offset income tax paid in high tax rate countries against tax paid in low tax rate countries. By following the ordinary credit method, India will still not give more foreign tax credit than is payable on that income. If you see the example, still the foreign tax credit will be limited to 145 to that extent. So by giving a pooling method, India is not losing by following a source by source principle. You are able to collect more taxes to that extent, and you are hurting the Indian business to that extent. So this was a suggestion that we had made in terms of how to compute. Now let us look at this very important aspect of excess foreign tax paid, which was the issue that Kota also talked about. In India, for instance, when we have this carry forward of losses, business losses that we have certain rules for set off against various heads of income, particularly in capital gains. You have short-term capital gains or long-term capital gain, debt, equity, all of this. You have some mechanisms of how to offset. Similarly, you also have some mechanisms to carry forward losses for a period of 7 years. This, of course, will apply under the old methodology. Under the new income tax rate, you can't carry forward from the earlier regime. Now, if you look at the foreign tax credit rules, also there is a mechanism of carry forward. Just the way you have carry forward of losses, you also have excess foreign tax paid. According to foreign tax rules, where the foreign tax paid exceeds the amount of tax payable in accordance with the provisions of the agreement for relief or avoidance of double taxation, such excess shall be ignored for the purposes of this clause. This is what the foreign tax rules in India talk about it. Now, many companies operate in different circumstances. 1 year they may be having profits, 1 year they may be having losses. So to that extent, they have the mechanism to offset. Even under the carryover of losses in India, you have the same mechanism. In one country, in 1 year, if you have incurred a loss for whatever reasons, you should be able to carry forward the losses. And the next year, if you are able to do so, you look at taxes over a period of 7 years so that it is balanced. Companies that do not receive full credits for taxes paid in foreign countries, technically they are called as excess credits. Excess credits could arise if a multinational company is carrying on business in a portfolio of countries where the income tax rate is higher than the income tax rate in the residence country. They have incurred losses. For instance, in the United States, we have the branch profit tax that I talked about. The branch profit tax is not, while it is computed every year, there may not be a liability depending on how the company operates. In one particular year, there may be a trigger of a branch profit tax, because of which the overall rate of tax in that particular country is more than the domestic tax rate. So there could be certain events like branch profit tax and things like that, which could also influence the amount of taxes that you pay. Excess, if the ratio of high tax income and the ratio of income earned from a high tax country during a financial year, the combination. Basically, when a company is operating in multiple countries, it's a portfolio. So the portfolio depends on how the income is. Many countries permit carry back and carry forward of excess credits. Now, this terminology of carry back is something which is popular outside India and not in India. We talked about business profits being carried forward in India for a period of 7 years or 8 years. Outside India, you have a mechanism of carrying back also. So to that extent, you have to revise your returns, and then whatever taxes, if you have incurred losses in this year, and if you have profits in the previous years, you can carry it back to 1 or 2, 3 years, and then you can get back a refund to that extent. That is a mechanism which is prevalent outside India. So many countries permit carry back and carry forward of excess credits. Let us look at how these countries are. Take, for instance, Canada. Excess foreign taxes that you pay in India, it is to be ignored, whereas Canada allows carry forward for 10 years, carry back for 3 years. Japan, carry forward for 3 years, carry back for 3 years. Singapore, no time limit for carry forward. UK, no time limit for carry forward, carry back 3 years, carry back. So many of these large countries permit it. And this is something that I had proposed to the committee in my write-up. Obviously, they have not considered. India should permit carry forward of excess credits for at least 10 years, so that if not 10 years today, they are providing for 7 years. Is it carry forward of losses in India is 7 years, right, Kota?
8 years. Depends. Most of it is 8 years.
8 years. So you can provide this carry forward of excess credits for 8 years, so that Indian companies can take credit in future years if the revenue from the portfolio of countries change. Is unable to take a credit, they should be given a choice to take a direction, as is the practice in many countries. This is an issue. I do not know if there was a question to that extent.
Yeah, there was a question.
There was a question about a direction of foreign tax credit.
If whatever excess tax credit you cannot take, whether you can take a deduction of the question.
Now, this issue is not addressed in the foreign tax credit. They are not talking anything about it. if you look at the principle of taxation in this country, income tax is basically a tax on the profits. They are not allowed as a deduction under section 40, under section 42, I think, under this one. So many countries allow, saying that if for any reason you are not able to take a credit of taxes, they should be able to give a deduction, as is the practice in many countries. To that extent. So this was a proposal that I have marked about. I'll come back to the deduction aspect a little later. Now, there is a concept called taxpaying credit. Do you have a time, Kota?
30 minutes more, sir.
Okay. Now, okay. Quickly, I'll just talk about one more aspect, which is the taxpaying credit. Now,
Around 15 minutes, 15,
Okay.
20 minutes, you can take.
Yeah, taxpaying credit. This is very, very important for Indian companies. Today, I have taken R&D tax credit in UK and in the United States. In the case of UK, it's a federal thing because anyway they don't have state taxes or any of those kind. Whereas in the case of United States, many of the states offer R&D tax credit. I have taken R&D tax credit in the United States and in the UK when I used to be in the United States, and there are significant amounts, particularly in the United States. Some countries also offer incentives, such as a tax holiday scheme that we have in Section 10A, 10B, and all those kind of things. They also have a tax holiday scheme. Basically, many countries offer these schemes to attract investments into those countries. Now, R&D tax credits and tax incentive schemes, they reduce the amount of corporate income tax payable in those foreign countries. If you look at the foreign R&D tax credit that they're talking about, for the amount of taxes that we pay, the credit is not something that they pay you by cash. If you have a tax liability in that country, you can offset that particular tax liability by this R&D tax credit. So this will correspondingly reduce. So today, because of this particular mechanism, the amount of taxes that you pay outside India will reduce by the R&D tax credits. In many countries, for a certain number of years, it can be as low as even 0 to that extent. When we pay a lower amount of taxes outside India, obviously the foreign tax credit will reduce because the amount of taxes that we pay. Foreign tax credit is basically the taxes paid outside India, and the taxes that you are paying outside India is reducing because of this particular scheme of incentive. Consequently, Indian companies who qualify for such incentives in those countries will not get any net benefit, as the global tax liability will remain the same. Is this clear? I will explain this in terms of an example, only then it will be better. Now let us imagine R&D tax credit is not claimed in a foreign country. So we operate in a country where there is no foreign tax credit. Let us assume for a moment that the corporate income tax paid in a foreign country, you ignore the currency, we are paid about 900. Let us assume that is $900 or 900 rupees, it doesn't matter. Tax payable in India on worldwide income, including the foreign source income from a branch, is 1500. So to that extent, this 1500 includes the $900 or 900 rupees equivalent paid outside India. Now, amount eligible for foreign tax credit, assuming corporate income tax rate in India is higher than the tax rate in the foreign country, you are able to take full tax credit because the tax that you have paid outside India is lower than the tax payable in India. So you get full tax credit. So you pay net tax payable in India on worldwide income after the foreign tax credit is 600 rupees. So tax payable on worldwide income is 1500, which is 600 plus 900. Is this clear, Kota?
Yes, yes.
This is clear, very clear, very simple.
Yeah.
Now let us interpose foreign tax credit in this. Corporate tax, income tax liability in a foreign country remains the same, which is $900, 900 rupees equivalent. You get an R&D tax credit, let us assume, of $800 or 800 rupees equivalent. So the corporate income tax that I pay in the foreign country is 100 rupees because I get a foreign tax, I get an R&D tax credit, which reduces my corporate federal income tax. Tax payable in India on worldwide income, including foreign source income from a branch, is 1500. as we have got in the previous example. In the previous example, we have got 1500. So tax payable in India on worldwide income, including foreign source income from a branch is 1500 when they compute taxes. Amount eligible for foreign tax credit in India is only 100 because I paid only 100. So the net tax payable in India on worldwide income is 1400. Okay, so the tax that I pay on worldwide income remains the same, which is 1500, which is 100 plus 1400. Let me repeat, there's a R&D tax credit of 800 rupees. Corporate income tax paid in the foreign country is 100 rupees. Tax payable in India on worldwide income, including foreign source income from a branch, remains at 1500 because global income into India rate. Amount eligible for foreign tax credit in India is 100 rupees because you only paid 100, so you get. So what is the benefit for this company of claiming R&D tax credit? In this example, I pay 1500 totally. In this example, I pay 1500 totally. The 1500 composition is different. I pay 900 outside India, I pay 600 in India. In this case, I pay 100 outside India and I pay 1400 in India. So with this kind of a scenario, why will I take my R&D tax credit, which is a significant benefit? Please remember, I also have expenses that I have to incur in engaging with a service provider to help me to claim this foreign tax credit and things like that. So in both the examples, the total tax payable worldwide remains the same at 1500. There is no benefit for the taxpayer in claiming the tax incentive in the foreign country. Some of the bilateral DTAs concluded by India, treaties with Canada, Cyprus, Japan, Kenya, Korea, Malaysia, they provide tax-paying benefits to an Indian taxpayer. Some of the treaties provide. It's not that all the treaties don't provide. Some provide, but they are not significant to that extent, particularly if I take UK and US, where I get a significant benefit. There is no such benefit that I have. Please look at the irony of this. The DTA is concluded between the government of India and the government of Australia, Canada, France, and the United Kingdom do not provide tax-paying benefits to Indian companies. However, these DTAs provide tax-paying benefits to companies in those countries. This is where the ironical issue is. In the United Kingdom, I get significant R&D tax benefits because I am employing very highly qualified people to earn my income there. But I am not able to get a credit, tax-paying credit under the treaty because it has not been negotiated. However, these same DTAs, for instance, if a foreign branch of this company is able to get 10A benefit in India, they get a tax-paying credit in those countries for Section 10A benefits, whereas I'm not able to get this kind of benefits because the treaty has been negotiated. I do not know who has negotiated the treaties, what was the frame of mind. I do not know their knowledge about all of these things. So India and the US have agreed that tax-paying credit, in the case of US, particularly the R&D tax credit is given by the states to that extent. So India and US have agreed that tax-paying credit shall not be provided in Article 25 unless US provides tax-paying credit under its treaty, tax laws, or under a DT with any other country. So to that extent, there is hope there, but still we are losing a significant amount of benefit because of the concept of tax-paying credit. I don't even know. I may be very rude and harsh in saying this. I don't even know if the tax authorities understand this concept of tax-paying credit, even though it is there in some of the treaties. Now let us look at the benefit if there was R&D tax credit, tax-paying credit under the treaty. Now you have a corporate income tax, same example 900, R&D tax credit you have 800, corporate income tax that you pay in the foreign country is 100 rupees. Tax payable in India is 1500. If you are going to take a tax-paying credit, amount eligible for foreign tax credit in India, assuming the rate in India is higher than the foreign, you get 100. This is what we talked about. Whereas if you are taking a tax-paying credit, you get an additional deduction which is deemed tax credit or tax-paying adjustment of 800, because of which the net tax payable in India on worldwide income is 600. The total tax payable on worldwide income for me reduces from 1500 to 700. Basically because that $800 rupees worth of foreign tax credit is something that is reducing. Now, what is the problem for India if they give a tax credit? Are they losing anything by giving me a tax paying? No, they don't lose anything. This is the first example where no R&D tax credit is claimed in the foreign country. What is the tax that I pay in India on the worldwide income? I pay $600, 600 rupees equivalent. Now, after I take the R&D tax credit, I continue to pay 600 rupees in India. So India is not losing anything by giving me an R&D tax credit. By not giving me a tax-paying credit, they are basically preventing me from taking the benefit which is offered by a foreign country. And this is something that also we had proposed. The tax payable in India worldwide would be. So they should provide a tax-paying framework under the treaties or under the foreign tax credit rules. Should be provided to Indian companies to encourage them to obtain the tax benefits, credits, and incentives provided in foreign countries. The value of income tax benefits, credits, and incentives, which is reduced from the corporate income tax, should also be reduced. So tax-paying credit will reduce the amount of worldwide income tax payable. However, the emphasis is India's tax collection would not reduce by providing tax-paying and tax credit benefits. This is also one of the aspects that I had covered in my presentation on my submission to the tax authorities, and they had not obviously considered this. This is a huge disincentive by not providing tax paying because the amount of credits that we get outside India is extremely high. Today, companies which operate, foreign companies which operate in India through a branch structure, they are able to get the benefits of Section 10A and things like that, and they get a tax paying outside India. Unfortunately, we don't get it. The last issue quickly that I can talk about is the taxation of dividends and underlying tax credit. This is what we talked about. So far, we talked about the juridical double taxation. This is essentially about the economic double taxation. Foreign source income earned by a subsidiary. We all talked about branches so far. Today, we are talking about a subsidiary. And foreign source income earned by a parent company in a foreign country through a subsidiary, it does not suffer double taxation, unlike in the case of a branch. However, there is a double taxation in the sense profits earned by the subsidiaries eventually accrue to the parent company. So there is a double taxation when they pay taxes in this country, subsidiary pays taxes in this country, and the parent company pays taxes in the foreign country on the dividend income. Now, as the parent company is earning taxes, earning income from a foreign in the form of dividends, withholding tax eventually becomes the liability of the parent company. Now, this double taxation is mitigated at two levels. The withholding tax can be reduced based on the TT rate. So many of the treaties provide you a lower withholding tax rate for dividend income as well. And the resident country provides relief from double taxation of the dividend income under this one. So today, for instance, if an Indian company is operating in the United States, the subsidiary operates in the United States, it pays taxes there. On the taxes, the withholding tax rate in the United States is 30%. Under the treaty, it is reduced to 15%. So you pay taxes at 25% under the treaty. And then you get a foreign tax credit in India to that extent of taxes, which is withheld in the United States. Now, there is a concept called underlying tax credit with reference to dividends is a tax credit provided in the residence country for the income tax paid in the foreign country on the underlying profit. Essentially, what you're saying is because you are a parent subsidiary, the subsidiary, the parent company will get a relief on the taxes paid by the subsidiary in the foreign country. The subsidiary, this relief may be given either under the unilateral relief under the domestic tax laws or under the DTA. Now let us look at one particular treaty, which is the treaty, which is surprising. The treaty concluded between the government of India and the government of Singapore permits an Indian company which owns or indirectly not less than 25% of the share capital of the company paying the dividend to claim underlying tax credit in India on the dividends received from such company. Okay, so this is in the case of Singapore, the Indian company can claim underlying tax credit in India on the dividends received from such company, provided you have more than 25% of the share capital. So as a concept, the Indian tax authorities have agreed underlying tax credit. Now let us again look at, just like in the case of a tax-paying issue, companies in Australia, Japan, USA, UK, they are able to claim underlying tax credit in their countries under the DTAs concluded with India. However, Indian companies are not similarly entitled to claim underlying tax credit in India under those categories. The issue that I talked about, that unfortunate issue that I had faced with the Indian tax authorities when I made the submission is, their view is, why should I provide any of these benefits under the domestic tax regulations? Because if we provide any of these benefits unilaterally under the foreign tax credit rules, then all the treaties that we have negotiated so far, they will lose its relevance. I just don't understand, how does it matter? You don't know who has concluded the treaty, in what time frame, under what circumstances. Today, India has become more global than what it used to be 25, 30 years back. So it is very important that all of these issues to be addressed in a foreign tax credit regulation. Unfortunately, the foreign tax credit rules in India does not address any of these issues, and we suffer because of the inability and the unwillingness of the Indian tax authorities in this country to address these issues. I am saying this openly in a public forum, but I don't know whether there's going to be any better reaction from the tax authorities to that extent. With this, I conclude my presentation. I can take those 2 questions or any more.
Yeah.
Now, this question, let me address this question. So you asked, one of the questions which is repeatedly asked, I do not know for what reason, in all the forums, is, an Indian company is operating outside India and they have paid foreign taxes outside India. They have incurred losses in India. Can I claim a foreign tax credit? Okay. There is a very appropriate income tax ruling in the case of Bank of India. They had in the similar circumstances. So the issue that they have said is, today I have incurred losses in India on an overall basis, but I have paid taxes. So to that extent, I want to claim foreign tax credit in India. The tribunal very clearly said, you can't get foreign tax credit in terms of a repayment of taxes. We are not going to pay you any amount of taxes because of this particular issue. The argument given by Bank of India in their proposal or in the litigation was, today you are reducing the amount of profits that I earned outside India, and to that extent you are reducing the amount of taxes that I pay in India, or you are reducing the amount of losses that we have. Okay, but still I am not able to get a tax credit. So because you are taking the reducing the profits, you should be able to give me that. The authorities very clearly said, you cannot get a refund of taxes because of this particular. This is the reality of the issue. But however, they said you can take a deduction of the foreign taxes because you are not able to claim a credit. Despite Section 48(2), they said you are able to take a credit. This issue was also addressed. The deduction versus credit issue was also addressed in the Tata Sons case, where the authorities said, even though 48(2) does not permit you, we believe that it should be allowed and you should be able to take a deduction. Yeah, tell me.
That one is okay. Next one is what is the document to claim foreign tax credit? I think but there is one question. Form 67 is what we have to through Form 67, and other documents they're asking. What are the documents required to claim the credit?
So basically, you have to give them the proof of tax paid. So for instance, if you have filed an income tax return, that is the best document that you can give. Otherwise, you have to give, ideally it should be the tax thing, because otherwise the sanctity of the documents is extremely important. So it's better that you provide a copy of the income tax return itself, so that they know what is the amount of taxes that you paid and what is the amount of income that you are offered to tax there.
But practically, we cannot file anything on the online when we file the income tax returns. So we have to wait for some notice or something like that. If they come, then only we can go and submit it.
I don't understand this. I don't assist in filing.
Yeah, with the income tax return, we cannot file anything, but we should have all those documents with us while calculating the foreign tax credit. And then whenever it is asked for, we should submit those things.
Yes.
And there is one more thing. The person who asked for claiming the excess tax credit, he said he was made to understand that there are contrary decisions to say that the same can be claimed as expenditure or otherwise. that excess foreign tax, excess trade, which you explained, you asked that. In India, you said there's a question of claiming excess tax credits.
Yeah, you can't claim under the treaty, under the foreign tax credit rules, excess taxes has to be ignored.
Oh.
Okay, there is one question for me from somebody called Sumit.
Yeah.
Deduction of foreign tax credit means in case of losses, please elaborate. See, this was a ruling given by the ITAT in the case of Bank of India, which was given in 2021 actually. In this case, the bank had incurred losses globally under India. Now they had paid taxes in many of the jurisdictions, foreign taxes, because they were profitable there. So when they filed the return, obviously the profits had to would reduce the amount of losses that they have. However, so to that extent, when they have a lower loss because of foreign income, the amount of carry forward losses will also get reduced to that extent, and they will pay taxes in India on the amount. Now the issue is, while the losses is reducing the global income, the taxes that they have paid, they are not able to get a credit under the circumstances. So the ruling was, India will not be able to refund income tax, foreign taxes that you have paid. India will not be able to do because it doesn't have a source of income for you to pay. If it has to pay taxes, it has to pay taxes from somebody else's domestic source income. Because your country, in your entity has not paid any taxes in India, it is not liable to pay any taxes because of its losses. So there won't be any refund of taxes. However, as a measure, mitigation measure, they said, because you are not getting credit under the taxes, you should be able to take a deduction of the foreign taxes in your income tax as an expense to that extent. So the losses to that extent will increase because you're taking a deduction to that extent.
Only the tax paid was allowed as a deduction.
Deduction to that
in
extent.
This specific case.
Despite 48(2).
Okay. So in this specific case, it was allowed. But the same principle, we have to see the situation whether we can take.
Yeah. Correct.
Okay.
Ideally, the solution to this is carry forward of excess losses, which India has not recognized.
So that we don't have. No. Okay. Okay. Thank you, Krishnan, for this wonderful explanation. Of course, not only the law, but also you shared your wide experience while you had while working with Infosys from all the countries' perspective, how the foreign tax rate works not only in India, but you have more knowledge how it works abroad rather than India. Because practically you worked with departments across the world. Only with CBDT you worked in India, but not income tax department, maybe to that extent, I feel. So definitely the members got a good feel of how this foreign tax rates works across the globe. Thank you once again on behalf of Bangalore branch. Maybe now request Panindra Gupta, Treasurer, to formally propose a vote of thanks. Panindra is there?
Yeah,
Panindra?
no, I'll do that. Thank you very much, CS Krishnan. We had an excellent session. Thank you very much on behalf of Bangalore branch and on behalf of all the participants here. For wholehearted thanks to CAS Krishnan. Thank you very much, friends. Let us take 10 minutes break, Mr. Kota.
Yeah, yes, sir. We can take.
Meantime, I think
Prasad is there.
Our next session speaker PVSS Prasad. Prasad sir, hearty welcome.
Thank you, Mr. Shetty.
Yeah, we will take a 10 minutes break if you say okay.
No, absolutely, whatever you decide.
Okay, we'll have a 10 minutes break because 2-hour session we had already. So we'll have 10 minutes break, sir. Then we'll rejoin in
because I have
6:07.
yes. On the timing.
5:57 now. 6:07.
Area, what time will we start?
6:10, sir. 6:10. 6:10.
How are you, Mr. Krishnan?
I'm fine, thank you. How are you?
So nice to meet you virtually. It's all virtual meetings now. No physical meeting. That is the unfortunate thing.
Participants, please join sharp by 6:10. We will have the next technical session.
Yeah.
Thank you. Thank you. Thank you, sir. 6:10
Thank
we will
you.
come back.
Thank you, Krishnan, sir. Thank you, Krishnan. If you are here, okay, means free, you can continue the session.
ಗೊತ್ತಾ ಸರ್ ನಾನು 6:10 ಶುರು ಮಾಡಿ ಆನಂತರ ನಾನೀಗ ಬ್ರಾಂಚ್ ಅಲ್ಲಿ ಇದ್ದೀನಿ. ಐ ವಿಲ್ ಗೋ ಟು ಹೋಮ್ ಅಂಡ್ ವಿಲ್ ರಿಜಾಯಿನ್. ಓಕೆ
Okay.
ಶುರು ಮಾಡಿ
Pani,
ಹೋಗ್ತೀನಿ.
Pani,
ಫಣೀಂದ್ರ
Panindra
ಆಲ್ಸೋ
ilva?
ಇಸ್ ಇನ್ ದ ಬ್ರಾಂಚ್. ನಾವಿಬ್ರು ಬ್ರಾಂಚ್ ಅಲ್ಲಿ ಇದ್ವಿ. ಒಂದು ಆಫೀಸ್ ಬೇರೆ ಮೀಟಿಂಗ್ ಇತ್ತು.
Sir, ಅದನ್ನ ನೋಡ್ದೆ.
ಸೊ ಬೋತ್ ಆಫ್ ಅಸ್
ನೋಡ್ದೆ,
ಸ್ಟಾರ್ಟ್ ದ ಪ್ರೋಗ್ರಾಮ್, ದೆನ್ ವಿಲ್ ಗೋ ಅಂಡ್ ವಿಲ್ ಜಾಯಿನ್ ಬ್ಯಾಕ್.
Okay, no problem.
ಓಕೆ ಓಕೆ ಥ್ಯಾಂಕ್ ಯು.
No problem, sir.
Okay.
Sir, 6:10 we will log in. Means again we will come back, sir. PV Prasad, sir.
Yes, yes.
Prasad, sir.
Okay, okay.
6:10 we will again. I will rejoin at 6:10.
6:10 will be back. Even I will be back at 6:10. Okay.
Okay, sir.
Hello. Shall we start? Kottavarelli, Panindra.
Sir, he's online, sir.
Hello.
Yeah. Yeah.
Shall we start?
Marcus. Yes, sir. Yes, sir.
Yes, friends, welcome back. Let us move on to our next technical session. To enlighten us on this session, we have an eminent speaker from Hyderabad, CA PVSS Prasad is with us. On behalf of Bangalore branch and on behalf of all the participants here, hearty welcome to CA Prasad. Hearty welcome, sir. Friends, just to inform you, day after tomorrow, Sunday, is International MSME Day. Bangalore branch is hosting program along with the Pinya Industries Association. This program on Sunday evening 3 p.m. to 5:15 p.m. I request all the members to join that program. There will be a structured CPE credit of 2 hours also for your benefit. So interesting program. I request all the participants and join and also inform your friends and colleagues. With that note, once again, hearty welcome back. Hearty welcome to our eminent speaker. Over to Panindra.
1 minute, sir.
Yes, please.
Yes, sir.
Yeah. Once again, let me also welcome PVSS Prasad. Chairman, you said he is from Hyderabad. Now he is settled in Bangalore. He is from Karnataka now.
Oh, I'm sorry.
No, no problem. Recently, he shifted himself from Hyderabad to Bangalore. Now he is our man of Karnataka now. The participants today we are discussing about equalization levy. In fact, if I just have to tell you about Indian cinema, all of us are aware that now it's a trend where you will get series 1, 2, 3, 4 like that. Like there are a lot of movies where part 1, part 2, part 3, part 4 it keeps coming. And if you want to remember the famous movie, recent movies, we can remember this Bahubali 1 and Bahubali 2. And similarly in Kannada also we have one movie, KGF chapter 1, and we are waiting for KGF chapter 2. So this was the Indian cinema was influenced, like it influenced even our CBDT, our income tax department, and they also come out with series 1 and series 2 of equalization levy. Initially in 2016, EL1 has come, and in 2020, EL2 has come. So to know more about this part 1 and part 2 of equalization levy, we have PVSS Prasad sir, who is initially from Hyderabad. Recently, he has come to Karnataka and he is settled in Bangalore. Once again, welcome on behalf of all. Yes, sir.
No, in fact, I'm a resident of Hyderabad only. Who told I have shifted to Bangalore?
Oh, sorry, sir. Then, sorry.
No, that is
Other person,
Sampath.
I think. Sorry. Sampath Raghunathan. I'm sorry,
Exactly.
So
Sampath
I'm corrected.
shifted to, he's my good friend. He shifted to Bangalore.
Correct.
But I am
Yeah.
a permanent resident of
Okay,
Hyderabad.
sir. Sorry. Yeah. So I stand corrected participants because I was also talking to Sampath Raghunathan sir. So he shifted. So I thought, sir, from Hyderabad. Welcome to you once again. And I request Panindra to introduce the speaker and hand over the session to Prasad sir.
Sure, sir. So welcome back, panelists and again members for today's session. So to give a brief introduction about PVSS Prasad sir, he's a practicing chartered accountant and an information system auditor, and is a partner of Mrs. Prasad and Prasad Chartered Accountants, Hyderabad since 1986. He was past chairman of Hyderabad branch of ICAI. He was the past president of AP Tax Bar Association and International Fiscal Association Hyderabad subchapter. He's also past member of Executive Committee of International Fiscal Association Indian branch. He authored and co-authored a book titled International Taxation, a Basic Study, published by Book Corporation, Kolkata. He was appointed as one of the branch reporters for IFA Congress 2010 that was held at Rome, Italy, on the subject of tax treaties and tax avoidance, application of anti-avoidance provisions. He was chairman of All India Federation of Tax Practitioners, South Zone for a term 10 and 11. He was also co-opted member of Committee of International Taxation of ICAI during the year 2016-17. He was invited to speak at IFA Asia Africa Conference held in Mauritius in May 2014 and May 2016. He is also a co-opted member of Committee on International Taxation of ICAI during 2018-19. He was elected as Vice Chairman of IFA India branch in 2018 to 20. He was invited as a panelist at Asia Pacific Regional Tax Conference 2016 held at Seoul, South Korea in May 2016. With this brief introduction, I welcome once again PVSS Prasad sir, and over to you, sir.
Thank you. Thank you, my good friend Kota Srinivas, Chairman Mr. Shetty and Mr. Panindra Gupta. It's my pleasure to join the Bangalore program on international taxation. In fact, Kota invited me almost 2.5 months back. I think he has lined up this program well in advance, and I'm very happy to be part of this program. And without losing any time, I would like to share the presentation and get started. No, in fact, as rightly told by Kota Srinivas, this equalization levy is having different avatar from 2020 as a version 2.0, as it was 1.0, which was started in 2016. See, as you all know, now I think whenever there is any audibility issue, please let me know. I think I'm quite clear. I mean, the voice is quite clear.
So this is clear. This presentation, if you can select that, what do you call the slideshow, it will be bigger, sir.
This is
You may have-
slideshow. I selected slideshow only.
Yeah, it is in slides only, sir.
No, it is not. But it is not coming fully, sir. Even the other panel is coming.
I don't know why, because this is the slideshow.
Now it's okay. Now it's okay, sir. Now it is okay.
Okay.
Prasad, you need to minimize the other ones.
Now it is okay, sir.
You need to minimize the layout of the panelists.
Correct.
It's proper, sir. No?
So
Shall
now
I
it
do
is
that?
proper. You carry on, sir.
Is it okay now?
Yes, sir.
It's okay, sir. You continue, sir.
Okay. So the equalization levy, as we all are familiar now with the 2.0, we need to familiar in the sense we have been hearing about it, what implications it has, how it's going to impact the transactions, and how it's going to create unintended consequences. This is all we need to really know about it. And in fact, the basis for this equalization levy is how to tax digital transactions. That is the origin of this entire levy, which was brought in 2016. As you all know, the BEPS action plans 1 to 15, which were tabled in October 2015. Action plan 1 deals with digital taxation. The action plan 1 report was not finalized. It was kept open for much more work to be done in that context. And because they could understand that digital economy is growing in a phenomenal way, and that cannot be ring fenced, which is not, it may not be impossible, but it's very difficult to ring fence the same. Hence, they would like to conduct a more consultative process involving all the stakeholders, and then arriving at what type of approach needs to be adopted and what type of taxing rules have to be adopted to tax the digital economy. See, as a part of their interim observations or ad hoc observations, they mentioned that there are 3 challenges of the digital economy. One is nexus. How a nexus theory works in the digital economy is the biggest debate that is going on now. Even the action plan 1 is under serious debate now with pillar 1, pillar 2 proposals, which are yet to take the final shape. And then data, whether gathering data creates a nexus. Facebook gathers data, Google gathers data, whether it creates a nexus. and then characterization of income. These are the three important, these are the three important criteria that have been listed out by the Action Plan 1 report. And in fact, at the same time, they have also identified three important characteristics from this digital economy. That is the cross-jurisdictional scale without mass. There is a without physical presence. I mean, companies like Google, Facebook can create a significant presence. There is no requirement of any physical presence with a significant, with a what you say, virtual presence, not significant. With a virtual presence, they can really do a lot of business. So that way, scale without mass is one of the characteristics identified. And then reliance on intangible assets in a big way. The IP-related products act in a big way in this business model. And then data and user participation is the, lifeline for this activity. As you all know, today, the data is collected from, crores and crores of users across the world, including India, by companies like Facebook and Google, and nothing is charged, and the data is collected from the users, and the users in turn, they are able to use various utilities being provided by these companies without any charge. So this is a peculiar revenue model which has yielded enormous benefits to these multinational corporations. In the process, what is happening, having got such a huge user base, they are able to exploit and get huge advertisement revenue in their digital platforms. And in fact, with these three characteristics identified, and in fact, they have suggested three interim measures. In fact, suggested in the sense they have listed out, but not recommended any measure, and it is up to the respective tax jurisdictions for them to decide and implement with all checks and balances. And in fact, in that direction, significant economic presence is one proposition they have suggested. Withholding taxes is the other one, and equalization levy is the third one. Significant economic presence, that is through digital and user-based factors, which we have discussed just now, that demonstrate a sustained interaction with the jurisdiction. Though they are not physically present, the corporates, the multinationals, with their digital means, there is a continuous and a constant interaction with the users in that particular jurisdiction. So that is the significant economic presence. And then second is the withholding tax, that is B2C, which is a very challenging task. It's not a B2B, it's a B2C, which would be a business to consumer, which would be a very challenging task. And the third one is the equalization levy. And in fact, when these three measures were suggested and not recommended, it was very clearly spelled out that while implementing any of these measures through the domestic law, it is very incumbent on each and every tax jurisdiction to comply with the treaty obligations, to honor and respect the treaty obligations. You can no way overlook the treaty obligation and get into implementation of these particular measures, any of the measures that is going to be taken up. As you know, the moment this 2015 October report has been submitted, India jumped at it, and in 2016 Finance Act, it has been brought out in the form of equalization levy. This measure of EL 1.0 was brought in 2016, only targeting online advertisement revenue being earned by non-residents, that too as a B2B transaction. Only when a person who is into business or profession in India paying any advertisement revenue charges to a non-resident, then he is under an obligation, that service recipient was under an obligation to withhold taxes. It's almost like a withholding tax at the rate of 6%. At the outset, let me clarify that equalization levy is administered through Finance Act, Chapter 8, which is not forming part of the income tax law. This is not part of the income tax law. This is altogether a different levy. So that equalization levy 1.0 did not really create any sort of discomfort to the international community, because though it has created some sort of unwanted obligation on the resident service recipient, who ultimately bore the cost. So it is not that a company like Google, who is going to accommodate advertisement space at a particular charge, is going to allow this amount to be deducted against the payments to be made to that company. Because of the low bargaining capacity, the Indian service recipient was ultimately bearing. It is something like 195A. It gets crossed up, and it is an additional cost that is incurred by the resident of India. But of course, it did not create any sort of pain to these multinational enterprises. That is the reason there was no, hue and cry from any countries like USA and all that time for the equalization levy 1.0. So 1.0 might not have really yielded the amount of revenues that government was looking at, but it was a starter. It was a starter. First, we need to bear in mind that is out of the income tax law, so not covered by the tax laws, not covered by the tax treaties. With the same approach, when this action plan 1, which is not concluded, even after releasing all the reports and even after finalizing the multilateral instrument, adopting action plan 2, 5, 7 and 14 into MLI, and other measures being taken up in the respective domestic domestic legislations of the country, like 94B, we have adopted the import of the BEPS action plan 4 relating to interest limitation. So some of the BEPS action plans are to be implemented as domestic tax measures, as amendments to be brought in the existing tax laws, and the other action plans are incorporated into MLI, which MLI has become a reality today. On 7th June 2017, as many as 67 countries in the first batch of signatories signed MLI in Paris. India is one of the front runners, being part of the first lot of 67, first batch of 67 countries. And in India, from 1st April 2020, MLI has become a reality. We are totally in a different metamorphic phase where the international tax rules are rewritten, and we are trying to adjust ourselves and settle down in this new environment. In this backdrop, only one action plan which was not finalized is the digital taxation. That is the action plan 1, challenges with respect to digitalization of the economy. And that is under active debate, having seen MLI a reality, having put MLI in place. Now OECD G20 BEPS initiative with inclusive framework with more than 135 countries are totally focused on how to bring digital taxation rules in place. That is the biggest agenda now. In that direction, we have, of course, we have, the original, what you say, the Secretariat proposals were put in place in October to December 2019 for discussion among the stakeholders in the form of Pillar 1, Pillar 2. Pillar 1 talks about the digital taxation. Pillar 2 talks about the global minimum taxation, which is now in news from last 1 month. So these two, Pillar 1, Pillar 2, could not really take off in 2020, which was supposed to be the watershed year and in concluding this proposal. But because of the COVID pandemic, everything went into the back burner. And in fact, US also did not give its green signal for the Pillar 1 proposal tabled by the OECD Secretariat. So in this backdrop, what happened? The entire, the initiative is kept on hold. Of course, the discussions are still going on, and there is some hope that there would be a consensus with the green signal coming from the US. Now, that is the, the present status of this Pillar 1, Pillar 2 proposals. And in fact, UK and USA specifically have gone on a joint statement committing themselves with the Pillar 2 proposals of the global minimum tax rate. And at the same time, they also expressed a fond hope that July 2021, there is going to be a G20 finance ministers meeting, I think on the 9th or 10th of July, if I'm not wrong, along with the central bank governors meeting is there. And that is going to really yield some results, is the fond hope that would see some sort of direction and consensus in this approach. So the whole issue is, without physical presence, when corporations are able to enter into jurisdictions and make earnings, how to capture such transaction and how to bring about a taxing rule which is acceptable to one and all. So this is the biggest challenge. Pillar 1 has given amount A, amount B, amount C approach, which was fraught with some sort of inconsistencies when reported by the stakeholders. I think they have brought out the blueprints recently, blueprint with respect to Pillar 1 and Pillar 2, which is again under discussion. And we can see some sort of development coming up in July 2021 G20 finance ministers meeting. Let us hope something would happen. Pending that, because this consensus is getting delayed and every country started taking up unilateral measures like what India did in the form of equalization levy. Many other countries have followed this suit, and many unilateral measures have been put in place. The common understanding today is, once there is a consensus approach that is agreed upon at the OECD G20 BEPS initiative, then all these countries, including India, which has brought in the unilateral measures, must really reverse these measures and undo these measures and fall in line with the overall consensus approach. So anyhow, let us see what India is going to do. Be that as it may, now this equalization levy 2.0 has got some far-reaching implications which we would like to understand. And as I mentioned to you, originally the EL 1.0 did not bother, especially countries like US and others, so much because EL 2.0 is a legislation which has cast the obligation on the non-resident himself. Unlike the approach was what was adapted in EL 1.0, making the resident service recipient on a B2B context to be made accountable for withholding of that 6% levy. EL 2.0 is a direct levy on the non-resident e-commerce operator and non-resident who has no permanent establishment in India, and such non-resident is now brought to tax in the form of equalization levy. Though continuously government claims that it is not income tax, by and large this levy is administered with the help of the income tax provisions only, which we'll come to understand little later as we get along with the slides. So, and in fact, before getting into the subject proper, it is also important to note that GST law, they have brought in one particular tax called online information data access and retrieval services, namely those facilitated by information technology via internet or an electronic network, which almost targets the same services which are targeted by equalization levy and that WOIDAR, they call it, that is online database access and retrieval services. That way, there is already a GST levy on this, and on the same tax base, you are going to apply another levy, which is whether it is justified constitutionally, we will discuss in the slides to come. So GST levy would operate and equalization levy would operate. Both are different tax codes, and there is no way you can adjust one against the other. And quickly coming to the levy, how it operates, the levy applies on the amount of consideration received or receivable by a non-resident e-commerce operator. That is what we need to bear in mind. Who is an e-commerce operator in this context? He should be a non-resident. So and any consideration received or receivable by a non-resident e-commerce operator from e-commerce supply or services, supplies with respect to goods, services made, provided, or facilitated. See, the goods would have been sold by the non-resident e-commerce operator belonging to himself on the online platform, or it could be services rendered by himself, or it could be goods or services belonging to third party being facilitated by him through his platform. All these combinations get covered in this EL 2.0. And it is very clear that e-commerce operator must be a non-resident. It is not the resident e-commerce operators that are covered by this levy, because the whole purpose is to tax those non-residents who operate in a virtual manner, making revenues from countries like India. And then online sale of goods owned by the e-commerce operator, or online provision of services, as I mentioned, or facilitation of the online sale of goods provision, or both belonging to a third party. Or it could be a combination of any of these services. While the levy is at the rate of 2% on the consideration received or receivable, there is an income tax exemption to ensure that there is no double tax. And this is where there is always a linkage with the provisions of the income tax law. And thereby you cannot deny that it has all the characteristics of an income tax. But be that as it may, now there is a exemption that is provided in the form of 1050, which is made effective from 1/4/2020. There was a drafting error when this provisions were moved without any sort of discussion in the parliament. As you all know, when the pandemic started, then Indian government thought pandemic started after the bill was presented in 2020, the finance bill. And then when the pandemic started and the lockdown started and all that, then at that time when the finance bill was moved in the parliament for the parliament assent to make it an act or a legislation, then without any sort of discussion or debate, this EL 2.0 was straight away brought into Finance Act 2020. So there was a drafting error. The corresponding exemption from income tax law under 1050 was not made effective from 1/4/2020, and by mistake it was it was put from 1/4/2021, which got rectified in this finance bill. And then there are three exemptions or exceptions, you can say. The e-commerce operator, if he has a PE in India and this e-commerce supplier services is effectively connected with that PE, then the same is not covered by this equalization levy. That you need to bear in mind. And second thing is, if a particular service is already covered by EL 1.0 under 165, provision of 165, then also you don't have to, you cannot bring it under EL 2.0. That is what it is. And then if the sales turnover or gross receipts are less than 2 crores, is less than 2 crores during the previous, then also, EL 2.0 has no application. And there are certain amendments that are brought in by the Finance Act 2021, which we need to quickly know before getting into the other provisions. Equalization levy is to be charged on the gross amount. See, there was a lot of representation made, as we have discussed a little earlier. The non-resident e-commerce operator would have been engaged in selling his own goods or rendering services by himself, or he could facilitate goods or services belonging to a third party through the e-commerce platform. So if at all, rightfully thinking so, if at all he is facilitating a transaction of a third party, then it is very much justified only to consider the commission or the facilitation fee received by such non-resident e-commerce operator for the purpose of EL 2.0, for the purpose of levy. But unfortunately, they have clarified through an amendment in Finance Bill 2021 or Finance Act, it has become now that irrespective of whether he owns the goods or not, the entire gross amount must be considered for the purpose of calculating the levy of 2%. And shall not include, of course, simultaneously, one exemption is provided, shall not include consideration for sale of goods or provision of services which belong to a resident of India or belongs to a permanent establishment in India of a non-resident. And such goods or services activity is actively connected with such PE. And if you just look at this illustration quickly, if at all, let us say, Mr. A orders goods worth $1,000 from Amazon.com, that is, A is a resident India, ordering goods worth $1,000 from Amazon.com. And the owner of the goods is another Mr. B, US resident. The Amazon.com needs to pay equalization levy on the entire amount of 1,000, and though it earns only a commission of 10. On the other hand, if a resident India orders goods worth 75,000 from Amazon.in, and those goods are owned by C, a resident Indian, then the Amazon needs to pay equalization levy only on the commission income earned. Of course, this is one conservative opinion being rendered here. In fact, when the provisions have been amended, it is worded in such a manner that consideration for sale of goods, irrespective of whether the e-commerce operator owns the goods or not. However, it shall not include consideration for sale of such goods which are owned by a person resident in India or by a permanent establishment of India of a person non-resident in India. So when they have mentioned that the consideration itself should not include the consideration relating to goods which are sold, which are owned by a resident, definitely there should not be any equalization levy on that, according to me. But one conservative approach is, in this particular scenario, the entire gross amount would not be taken for the purpose of calculation of levy, but the commission what is earned by the non-resident e-commerce operator would be subjected to levy. That is what is one of the opinions. I am not concluding on this. And then scope of the online sale of goods. Then there is a representation made before budget 2020-21 stating that there are many transactions that happen in a multifarious manner. In the sense, I would have ordered online, but the physical delivery happens offline and the service is rendered offline. This is not a service which I can utilize online. Say a hotel booking, I might have done the hotel booking online, but the hotel room that is booked is availed and enjoyed offline physically. In the same way, a car rental. All these things, they are because these days it is all, the bookings all happen online. So a clarification was sought that such transactions should be kept out of the purview of the EL. But unfortunately, the clarification has expanded the scope of EL. They said online provision of services to include one or more online services to include one or more of the following online activities, that is acceptance of offer or placing the purchase order, acceptance of the purchase order, payment, supply of goods, provision or services partly or whole. Any one item, if it is being done online, that is good enough to bring the trigger of EL on this transaction, which is very, very unfortunate and which is not legally justified. So undertaking any of these activities on a digital or electronic platform will trigger EL. The definition may likely to lead covering hitherto activities which are understood as offline activities or non-e-commerce activities are also getting covered, which requires the attention of the lawmakers again. And royalty and FTS is one important area where there is some sort of confusion, because a service which is brought under EL could also be a service which might be covered by a royalty or FTS clause of a particular tax treaty or the provisions of the domestic law. If at all, if it is covered by the royalty provisions or FTS provision, the tax could be higher than what a non-resident is paying as a levy of 2%. That way, there was a sort of welcome approach and trying to take and categorize such services under EL for the payment of a lesser levy of 2% as against the regular rate. So that has been clarified now. If at all it is being covered by the royalty provisions or FTS provision, there is no way you can bring it under the EL provisions. So that would be out of the purview of EL provisions. And now we need to remember a landmark judgment was delivered by the Honorable Supreme Court in the March 1st week in the case of Engineering Analysis Center of Excellence, where it was held by the Honorable Supreme Court as per the Copyright Act provisions that whatever this is off-the-shelf software that is shrink-wrapped software, if it is sold by a non-resident vendor to an Indian resident, it should be treated as a product and not to be treated as a royalty. So that create an issue is again, that is what I've given a small case study on this, which we can discuss in the later slides. And quickly, we must know what is 194 WO versus equalization levy. As you know, 194 WO is a tax deduction provision which obligation needs to be complied with by e-commerce operator in respect of payments being made to a resident e-commerce participant. The provision has clarified that e-commerce participant has to be a resident, but it is silent as far as e-commerce operator is concerned. So the most, the most probable view or the correct view would be even a non-resident e-commerce operator would get covered by the provisions of 194 WO. So as you know, there is some sort of threshold put for individuals and HUF when they have less than 5 lakh transaction and all that. Be that as it may, the obligation cast on e-commerce operator would extend even to a non-resident without any exception. That is what is the most popular view. And that is in respect of, whereas EL operates in respect of what we have discussed now. So whether EL 2.0 as well as 194 WO would operate simultaneously, what is the interplay? That was what is discussed now in these two slides. I sincerely, I'm of the sincere view that both would operate simultaneously. There is no mutual exclusivity on these two. And a small table has been drawn for immediate reference and for your immediate benefit of understanding. E-commerce operator is ECP and ECO is the e-commerce participant is ECP, ECO is the operator. If both are residents, 194 WO will apply, EL won't apply. If ECP, that is participant, is a resident, but operator is a non-resident, then also this 194 WO will apply, there is no doubt. And EL is only on the commission earned and not because it is the goods owned by the resident, that is the e-commerce participant is availing the facility through e-commerce operator to dispose of his goods who is a resident. Then EL would not apply, but the conservative view is the commission would get covered, but I'm not concluding on that. There is also a divided view that even the commission would not get covered for the EL purposes. And when ECP, that is the participant, is non-resident, obviously 194 WO has no application. And when the operator is a resident, obviously there is no EL 2.0. When both are NRs, definitely, the levy would operate with respect to such NRs who are fitting into the definition as given, who are using the Internet Protocol Address of India, or who are into that specified circumstances listed out. And also, we must keep a close guard on these cryptocurrency activities, which are in a big way happening these days. The Bitcoin is really shooting up again. It has some crash, and it is all like a stock market. We have been hearing about this crypto transactions regarding Bitcoin and Ethereum or something. There is one more, cryptocurrency. So there is a view that whatever transactions that are happening at a non-resident crypto exchange. Definitely, there could be, if a transaction is happening for the benefit of an Indian resident, EL could be applied, and 2% has to be paid by the non-resident operator who is doing this transaction. Then quickly, we have the procedural dates have been notified. It's a quarterly payment which needs to be made within 7 days from the end of the quarter. And if at all there is any delay, we have even penal provisions for non-compliance, and we have 100 days, 100 rupees per day for a day of non-compliance continues with respect to penalty for failure of filing the statement of compliance. You have prosecution provisions. You have penalty for failure of payment. All this is apart from interest at the rate of 1%. All this would operate, and these are all there in the provisions. Then quickly looking at some of the practical issues. See, this is with respect to a non-resident e-commerce operator, the equalization levy. It is not creditable because it is outside the purview of the income tax law, and it's outside the purview of the treaty law. And this is being administered through Finance Act. And accordingly, there is a view in real that it is not creditable as of now. But what is prescribed by BEPS Action Plan 1 is not really taken care in true spirit in India with respect to this legislation, because Action Plan 1 clearly suggested that one of these measures must be adopted under the domestic law, honoring the treaty obligations, but that's not being done. Whatever EL that is being paid by the non-resident, there is no way, he's not sure and he's not certain whether this would be creditable against the overall taxes he has to pay in his country. And this is a clear obligation. This is a clear violation of the treaty obligation, what India has agreed upon. And what constitutes a digital or an electronic facility or a platform is advice rendered through email or a telephone is also covered, is an issue. And it could be, again, who are all the assessing officers? They're all from the income tax department. Everything is going to be administered by the income tax department. We know how officers are going to be over enthusiastic, and definitely even if you take an advice on an email or telephone, there is a probable chance that this could be brought under the purview of EL. There is no clarity as to what is digital and electronic facility platform. Any service rendered by a non-resident through electronic or digital means can also be brought under the purview of EL. And then the quantum of consideration in the context of marketplace aggregator, this is one representation which is made with a lot of hue and cry, stating that only the facilitation fee or the commission earned by the non-resident e-commerce operator in the context of facilitating the sale of goods of a third party, that is the e-commerce participant. Even in such a scenario, it was clarified that the entire gross amount would be considered for the purpose of levy, except where the goods are owned by a resident of India or a PE of a non-resident, with which PE this activity is actively connected. And thereby, the claim or the representation remains unaddressed, and it would be still maintained by this non-resident e-commerce operators. And applicability to the intercompany transactions, there is no exception that is provided. If at all an ERP is used between large multinationals across the countries, and they have some intercompany transactions, even such group transactions are going to really be brought under the EL, which is the most undesirable consequence, and that is what also is not addressed by the Finance Act 2021. Applicability in cases where services are ordered or booked online, that is what I've discussed, a hotel booking done online, but the room is occupied and availed offline and enjoyed offline. Even then, there is a levy of, the levy is covering such transaction as per the amendment brought in by the Finance Act 2021. And the penalty, unfortunately, is appealable. When a penalty is levied, if there is the payment of levy is delayed, when a penalty is charged or levied by officer, by the assessing officer, then there is it is appealable, whereas the principal levy, if it is not properly computed, then there is no recourse for appeal under the existing provisions, which needs to be quickly brought in to protect the the taxpayers' interests. We must make a quick discussion whether EL is constitutionally valid. A very relevant discussion we need to make. I would strongly, advocate this theory because the legal pundits are of the view that EL 2.0 is not constitutionally valid. Probably in the days to come, months to come, or years to come, there could be a challenge before the courts of law. Treaty obligations, as I explained, are not complied with. It clearly violates Article 26, 27, and 31 of the Vienna Convention. The good faith principle is really compromised. The good faith principle, what we know, has really been compromised, which is the cornerstone or the bedrock of any tax treaty. And the legal pundits debate on entry 92C versus entry 97 of the Constitution relating to the EL's validity. So they have a view that 246A article overrides Article 246 or 246A overrides 246 existing article, and levy of GST takes precedence over any other levy, and accordingly resort to entry 97, that is the residual entry, may not be permissible. As you all know, when GST became a reality in India in 2017, there is also an amendment to the Constitution, whereby such amendment which is brought into the Constitution in the advent of GST taxation creates a sort of inflexibility. There is no way that entry 97, that is the residual entry, can be resorted to for bringing this levy under that garb. So many stakeholders intend to go to the court of law as per the latest media reports. That is what in multiple taxes on the same transaction, as I explained to you, IGST, popularly known as BOI-DAR, which I have explained in the beginning, and that is administered under IGST, and equalization levy, both are overlapping levies on the same tax base of the same transaction. There is no foreign tax credit in the residence jurisdiction, which is a real hardship to the non-resident, and then disallowance under 40IB. From one side, you say it is not part of the income tax law. From the other side, you try to tighten administering this particular levy with all the provisions of the income tax law. If at all this levy is not paid, and then 40IB, that is the disallowance, is going to happen. Of course, the disallowance can happen only if at all the non-resident has a PE. If at all he has a PE, there is no way you can bring EL on such person, because the PE taxation is is as per the income tax law. EL is income tax in guise, definitely. As I told you, many provisions. If you go everywhere, when you go to the definition article in 163, you have 164, you have all the definitions. All the definitions are borrowed from the income tax law, more or less. So the action plan 1 proposition is not followed in its full and true spirit. Thereby, EL 2.0 is definitely a violation of the same. And this EL can have some sort of friction and confrontation with some of the indirect taxes issues, like there could be a customs duty. There is a high chance of overlapping of EL as well as the customs duty. Then there could be also a customs valuation where the value of the product should be inclusive of the EL also, because EL is being levied. On the top of it, you will calculate the customs duty, could be something. And again, whether filing of equalization levy return can trigger some sort of registration compliance under the GST law is also, is being apprehended. And there are agreements on tax treatment of the digital supply of goods within the framework of the World's Custom Organization. An equalization levy be seen as violating those agreements is also one of the concerns. Then some of the recommendations I would quickly go through. It should be clarified that electronic supply and services through e-commerce operator, that is EL, is restricted to digitalized products and services and does not cover goods and services which are physical in nature, which are enjoyed physically. That is what. But Finance Act 2021 did not accept that. And the second one is, it is justified to argue that convenience fee commission should only be brought when they are acting as facilitators, which also has been reversed. And in fact, there is an expanding provision that is brought in, which expands the scope of the EL, which is also a very unwelcome amendment brought in through the Finance Act 2021. And also, when you talk about the convenience of fee and all that, we should think about targeting market region wise rather than a specific country. This creates a complexity when multinationals operate in the global level. They take up regions and then try to do their costing and all. This creates a complexity as to how much consideration for the sale of advertisement shall be allocated to persons accessing the advertisement in India and outside. This is a very practical problem, and specific appeal remedy dispute resolution provision should be included. That is what is important. And these are all, when there is pillar one consensus approach that is going to come up, if at all we see the light of the day for the OECD pillar one, pillar two proposals, whatever we are paying now, whatever we in the sense the non-resident e-commerce operators, whatever they are paying now, can that be credited against the future digital tax is one genuine concern of the non-residents. And it is justified to canvass that EL paid by non-resident e-commerce operator should be adjusted against tax liability of the PE. If at all a PE is going to be triggered by the non-resident e-commerce operator in the same year. When once PE triggers, EL is not there. But whatever EL has paid before PE triggered, could it be adjusted is a genuine concern. And then, as I mentioned, there is no specific appellate remedy for the levy itself. Unfortunately, there is only an appellate remedy for the penalty levied and not the main levy. And then let us quickly look at one case study in the advent of the Supreme Court judgment, what I mentioned a little earlier. X enters into a license agreement and sells licensed software to Y Limited in India through digital means. So X Incorporated is in US, let us say, Y Limited is an Indian resident and receiving a shrimp wrap software, and later Supreme Court judgment holds the view that the same is to be treated as, holds the ratio that same has to be treated as a product and not to be treated as an item of royalty payment. And then Finance Bill 2021 proposed that the consideration taxable as royalty. Finance Bill, it's now Finance Act, that consideration which is to be treated as a royalty or FTS should be out of the purview of EL. Because this is not royalty, now that this is a shrink wrap software, is the payment for that is not a royalty payment, which will not suffer tax with respect to the royalty taxation. Can it be brought under EL is the question. Whether such transaction is covered by EL 2.0 is a very, very genuine concern being, doing rounds, and there is no ready answer for that. And in fact, prior to the Supreme Court judgment, license fee paid has been considered by the revenue as a royalty, as I mentioned. And both under the domestic law and under the treaty law, tax authorities were taking a view that it is royalty and trying to levy tax in spite of many judgments for and against. Of course, the final finality was given to the same issue by the Honorable Supreme Court. Post that, now can the revenue authorities start applying EL levy, that is the equalization levy, is an issue to be addressed. And the popular view is EL can be applied for such transactions where the non-resident vendor has no PE in India. And quickly coming to the, how it is happening in the global manner, global level. France has got its own digital services tax with some thresholds and all that. When they have tried to implement the same, the US has come heavily on France, and the USTR, that is the US state, United States Trade Representative, found the French DST to be actionable under Section 301 as it discriminates against US digital companies. And of course, on 10th July 2020, US announced the imposition of additional tariffs against some of the French products, but it was kept on abeyance through a subsequent notification. In the same manner, now even against the EL 2.0, UST, that is the United States Trade Representative, carried on its investigation, and they have come out with their final report on 6th January 2021, wherein it was held that EL 2.0 is a discriminatory against US companies, contravenes international tax principles, and burdens or restricts US commerce, and found it to be actionable under Section 301 of the US Trade Act 1974. India readily responded, stating that it's an enactment to ensure fair competition, reasonableness, and an exercise of the government to tax businesses that have close nexus with the Indian markets. Be that as it may, they have not agreed to that, and they have ruled on the 6th January ruling that it's actionable under 301 of the Trade Act. But however, the latest development is that USTR, by its press release dated 2nd June, has announced interim suspension of tariffs over digital services tax investigation for up to 180 days, that is the next 6 months, with the 6 trading partners, including India, and clarified that period of 180 days is provided as an additional time to arrive at a consensus at the OECD G20 BEPS initiative. If at all there is a consensus-driven solution for the digital taxation comes up successfully, then probably this action under 301 may be dropped, as all countries have to suspend and withdraw the unilateral measures and have to fall in line with the consensus approach that is expected. And we also have countries like Indonesia and Malaysia and Philippines and Singapore have come with their respective legislations, unilateral measures on digital taxation. And all these countries must definitely reverse their unilateral measures once they fall in line with the consensus approach. But definitely the consensus approach is not that easy, because there are so many ifs and buts, and the Pillar 1 proposals have got so many gray areas which are still to be addressed. Be that as it may, we also have proposal that has come from the UN model. As you know, Article 12B, which is popularly known as Rajat Bansal model, which has taken shape. Rajat Bansal is the earlier competent authority, and now he's promoted as a chief commissioner and chief commissioner rank, and he is a nominee from the Indian government in the UN committee. And the UN committee also actively discussed and debated in respect of digital taxation, and they have arrived at an Article 12B targeted to come out with a taxing rule on automated digital services. Finally, the tax rate is suggested as a percentage of gross amount of the payments underlying the income and not the income as provided in the earlier draft. Be that as it may, broadly, I want to bring to your knowledge that Article 12B is also a parallel proposal which has taken some sort of finality, because the UN committee has approved this and adopted this as an article in UN Model Convention along with the commentary in the month of April 2021 recently. And with this background, we will get into any sort of questions I can take up, and this is what I thought I should bring it to your knowledge in the limited time available, but district taxation is in thing, and we'll have to, yes. We'll have to eagerly wait and then see. 1 minute, I will stop sharing. And Mr. Srinivas, now I'm through with my presentation. And if there are any questions, we can take them.
I'm just seeing the questions. If any questions has come to you directly, just see, sir. I'll be seeing in the general box.
I have to see the chat box, no? Or
yeah, both chat box and question and answer.
Acha. So I'm just
question and answer. I'm not getting anything. I'll in chat box.
There are some questions here.
So old was there in question and answer. Sir, one question is here. I'll just ask you that, sir.
Yes.
Whether advice via email by a foreign consultant to an Indian party would be liable to TDS.
TDS. He's not asking about EL.
Yeah.
He's talking about.
Equally, he's asking about TDS. Correct.
And shall I take it as EL?
Yeah, maybe you can take it as EL, sir.
What he means to ask is whether EL is leviable or not. So that is what is apprehended now, because the digital facility or the platform is not really. 1 minute now.
Yeah.
Is not really defined very clearly, and we all have all doubts and concerns that even such items could be roped in by the assessing officers.
Okay. And so there's one more question, two more questions. Whether limit of 2 crores would apply to revenue generated out of Indian customers or global income of the e-commerce operator?
No. See, when we are talking about a
levy EL2.
Yes, very. When we are talking about the levy being administered by the Indian authorities, obviously it is with reference to the targeted customers in India who are residents and also those non-residents who are using the Internet Protocol Address of India.
Okay. One more question.
So when I was talking, whether the audio was not clear or whether
it was okay, sir. No, it was clear, sir. Not an issue.
Because there is one chart here stating that the speaker's volume was low. Probably that was at their end, but all of you have heard me clearly. No? All of you have heard me clearly.
Yeah.
Yes.
There's one more question, sir. Whether the Indian deduct company making the remittance is liable to deduct the EL2 on grossing up basis.
No.
If it is not. Yeah.
As far as EL2 is concerned, the person who has to deduct, what did he mention there? Who has to deduct?
No, if non-resident is not doing, whether it can be collected.
No.
Crossing up basis, whether it can be deducted.
Yeah. No, because the EL provisions per se, there is no deemed agent or anything like representative SSC and all that. It is an enactment by itself under the Finance Act. This is an obligation cast on non-resident, and how the revenue authorities are going to administer this is a real challenge.
Okay. And they continue that question and they're asking in view of section 163, whether the Indian company will be considered as agent of the non-resident e-commerce operator and has to discharge the remittance of EL2 liability, which is not directly tagged in deductor.
I think the same question in a different manner. In a different manner. I strongly feel that there is no question of any representative SSC approach here for the EL2. There is no way. No way can drop in that.
Yeah. Okay. I think that's all in my chat box, sir. If you have anything to your personal thing.
Here also, there is one question whether limit of 2 crores would apply to revenue generated out that you have already read out. We have answered that. One more clarification which I thought I should really bring it to your notice. Whether this is constitutional or not is being debated by the legal pundits. Definitely it's going to be questioned because the treaty obligations are not being complied with, because EL is kept out of the purview of the tax law and also the treaty network, and thereby it is becoming an additional or a sunk cost for the non-residents. And in the latest edition, 11th edition of that is Law in Practice of Income Tax Law of Kanga and Palkiwala, which is authored by Arvind Attar, there is a very interesting observation by the author of this thing, and it is observed on 3726th page, that is volume 2. It is a settled principle that there can be no estoppel against a legislature. This principle will apply if the legislature is sovereign, but in India, it is the constitution that is sovereign. The legislature, like all other branches of government, are subject to constitutional limitations. Sooner or later, the Supreme Court will have to consider whether signing of a treaty and creation of a self-imposed limitation on legislative power can be transgressed by the same legislature. That is, through treaty, we have undertaken obligations which we are trying to bypass by bringing a levy which we say is not covered by the taxes of Article 2 of the treaty network. So that is what is being explained here. So, we'll have to consider whether signing of a treaty and creation of a self-imposed limitation on legislative power can be transgressed by the same legislature. That is like bringing EL 2.0. It is suggested that the principle that there can be no estoppel against legislature may have to be revised, particularly because India continues to tax transactions which are outside its territory and against individuals who are not resident and in violation of its treaty obligations. I think this is the considered view given by Arvind Attar in his 11th edition of Kanga and Palkiwala's commentary on the income tax law. And it's really my pleasure to be part of this international taxation network, which Kota Srinivas very successfully planned and lined up the whole show. Even on the first day when Bostwal inaugurated, my good friend, I have really participated in both the sessions, though not continuously. I was there in the session of TP Bostwal as well as in the session of Girish Ahujaji, and it was very good, and it's a real good, excellent virtual show conducted by the Bangalore branch, the chairman Shetty and Ms. Kota Srinivas. They really share the compliments for this good work. And I'm really happy to be part of this one. Thank you.
Thank you very much, sir. Thank you. So over to Chairman for your concluding remarks. Chairman, sir.
Thank you. Thank you very much. We had an excellent session on equalization levy, sir. So definitely all the participants enriched from this session. On behalf of Bangalore branch and on behalf of all the participants here, our wholehearted thanks to PVSS Prasad, CA PVSS Prasad, sir. Thank you very much.
It's my pleasure to
friends,
be part of this.
Friends, our wholehearted thanks to our coordinator, program coordinator, CA Kota Srinivas. Thank you very much. And thanks to each and every participants. Your active participation made this program a successful one. Thank you very much. Tomorrow, please join at 10 a.m. Tomorrow, there will be 6 hours support technical sessions starting from 10 a.m. to evening 5:30. Thank you very much. See you. Good night.
Thank you. All the best.
Good night, all of you. Thank you.
Kotaji. Thank you, Mr. Shetty ji.
Thank you, sir. Thank you very much.
Thank you, sir. Thank you very much.
All the best.
Sorry, sir. I just hello, sir. I just got confused with Sampath Raghunathan University. Sorry.
Sampath is my good friend. Sampath is my good friend. Recently, I spoke to him, and he gave me the news that he shifted to Bangalore. So then I could make out that you are, got confused on that.
Yeah.
I understand.
Yeah, I was speaking to him for this to make a presentation in these conferences. He said, no, he's shifting to Sampath Raghunathan, sir.
Okay.
So he said he's been shifting to Mangalore. So that's the reason.
So that is the reason he could not participate probably.
Yeah, one of the reason was that also.
Because he was shifting
Anyway.
to Bangalore and all that. Correct.
Correct, sir.
So
Thank you very much.
Thank you. All the best. All the
Thank
best.
Thank you.
All the best, Mr. Shetty.
Yes.